We're looking for a drag on payrolls from both the hurricanes and strike.
It's important for us to also acknowledge that labor market's going to be noisy.
It's going to be difficult to get a clean read on the signal and the noise.
The labor market, that while still solid, has slowed down quite a bit.
The bottom line is the labor market's actually pretty healthy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, coming into Friday, kicking off November. Seriously, equity futures on the S&P 500 positive by 1/3%, leaving behind the first month of losses since April on the S&P 500. Two words to watch this morning, two names, Apple and Amazon in the pre-market, and they look like this. Apple, a tepid forecast, a bit of softness in China. That stock is down 1.2%. Amazon, Bramo, flying up 6%.
To me, this highlights really the story of this tech earnings season. It really comes down to which tech company can convince everybody that when it spends on big tech, it actually has a path to profitability on the backside of that. And Apple, given the fact that it's falling off in China and given the fact that it's had this messy rollout with AI and the software and the hardware, people don't have that faith.
No, but they do when it comes to Amazon, even though AWS came in just a little bit shy. But when it comes to Apple, you have to think, if this is how bad it is now for them, and they're not being able to live up to those expectations, how bad could it be if the politics change in the United States and China becomes much more difficult for American companies to do business in?
In 2 hours and 30 minutes, the tech story will be a sideshow. The main event, payrolls Friday, just around the corner. The bond scores going into that. Yields look like this. Yields higher by a single basis point at the front end. 4.18 on 2s, on 10s. 429.47. The estimates, the median in our survey, 100K. Just to give you the range, the high, 180 at Mizuho. Here at Bloomberg Economics, the low, negative 10K.
So to me, how low does it have to be to change the narrative? That right now is about the positive surprises that has led to a nearly 50 basis point rise in the 10-year yield, and more than that on the 2-year yield over the month that just passed, which I can't believe because it feels like it was just happened, and we're still in October. So it raises this question, basically, has the narrative been set, especially given the fact that this jobs number is going to be, a pick your number, basically grab bag of whatever you want because it's going to be so messy.
Even without the hurricane impact, even without the Boeing impact, Bloomberg Economics' Anna Wong was talking about 150,000 that could have been added because they see underlying issues with the economy already, things like manufacturing. So what would be an absolute shock is if we print a higher number. And then what does that mean for the Federal Reserve next week?
So the random number generator drops at 8:30 Eastern time. Is the risk this morning a big number or a small number? I think we've been talking about the risk of a weak one for a while, but take this week's data. The lowest jobless claims since May, just yesterday. ADP delivering a big upside surprise. The labour differential in consumer confidence improving as well. So far, so good for the month of October.
Which is the reason why, especially given the really low expectations for this jobs number, a lot of people saying the risk is to the upside, especially given the rise in yields, especially given the surprise index, which is at its highest level going back to April. Again, it's messy if it's low. Is it messy if it's high? And I don't think anyone's saying that that's the case.
Good luck to the Federal Reserve next Thursday. Coming up this hour, Chris Verrone of Strategas ahead of a week full of event risk. Rob Casey of Signum Global Advisors as Harris makes a final appeal to female voters. And Tom Forte of Maxim Group on Apple's disappointing earnings report. We begin this hour with stocks inching higher going into the first of 3 big events. Payrolls later this morning, followed by the election on Tuesday and the Federal Reserve meeting just 2 days later. Chris Verrone of Strategas writing, historically, is the prevailing trend of the S&P that matters more for forward performance than the election outcome. Uptrend going into election, strength tends to carry over. Downtrend going into election, weakness often persists. Chris joins us now for more. Chris, good morning.
It's great to be here.
So what does this performance tell you about how we're going to perform coming out the other side of next week?
Yeah, I think, listen, we don't know what's going to happen next week, but we do know that the trend of the market's been positive, and it's been positive for 2 years, and I would expect a continuation of that. We just haven't seen, even the last couple of weeks, as the market's gotten a little choppy here, we haven't seen the real internal deterioration that I would expect ahead of a big problem. I don't know if you get a correction or a pullback post-election, but I do think it's ultimately viable. I think the leadership is still pretty good here, and I think the internals are still fairly good as well.
Let's talk about leadership. You talked about that pro-cyclical tilt, discretionary versus staples, what's happening with financials. What does that look like now?
Yeah, we always say, we don't really care about our opinion. We care about the markets, about how it interprets the economy. And I think what's been telling here, even as rates have backed up, you really haven't seen leadership move away from the pro-cyclical tone that's been in place for much of the summer and fall. For example, as you note, discretionary over staples. It's a very pro-cyclical tone. The financials have held their own here, even with rates up. I mean, that's a big difference from early 23, right, when you had rates up and regional banks falling apart. That has not been the case here. And then I think conversely, look at the market's more defensive areas. There's been no money into healthcare. There's been no money into staples. So I know the macro looks different with rates up. I don't think the leadership looks very different. That's ultimately more important for us.
Sentiment, though, feels really nervous, feels really jittery. I mean, some of the moves that we've seen, the single name moves after earnings, don't make sense in the scope of how big they are based on the actual numbers. I think of Microsoft. They came out, it wasn't that bad. The shares fell the most in 2 years. I'm looking at Apple. They beat across the board, but people are saying, show me the money in the future. And then you have some sort of massive surge in Intel because everyone had left it for dead. I mean, how much are we looking at a market that is so jumpy with no conviction that you're seeing these massive single name moves?
Well, I think it's interesting you're talking about a sector that's basically been split for 6 months. I mean, tech's is probably the one sector in our work where you've seen internal weakness start to show up, certainly over the course of the summer and into the fall. Microsoft, as an example, we should never be surprised by an outcome when the surprise is in the direction of the trend. Microsoft's been weakening all summer and all fall. I mean, it peaked in our relative work, I think, back in July of this year. So I don't think we should be shocked by that outcome. Look at the semis. Find me a group that's more split. We know NVIDIA, we know Broadcom, we know Taiwan Semi, basically at the highs. Where's Lam Research? Where's AMAT? Where's ASML? Where's Samsung? I mean, tech is probably the most split of any sector in our work here.
I love that you're talking about the actual specific stories. It raises a question of whether macro is broken down, of whether the bond stock correlation has completely gotten divorced, and you can't really gauge anything by that.
You know, I don't know. I know there's a lot of agita about the move in bond yields here the last couple of weeks, but I would put it in a little bit of context. I think people don't realize this. It sounds counterintuitive, but it's historically true. Following the first cut, rates actually tend to go up, even in 95. I mean, we had non-recessionary rate cuts, July 95. You had about a 75 basis point move higher in 10-year yields over the next 12 weeks. That ultimately resumed lower. I think importantly as well, as rates have gone up here, what hasn't happened, there's been no weakness in credit. I mean, double B spreads are on the low, triple C spreads are on the low. Maybe there's a hint of spread widening in MBS, but for the most part, credit conditions are not kind of confirming the move you've seen in yields. And then, Lisa, as you noted at the top, the surprise index has confirmed the move in yields. So I know I think the front page of the New York Times on Saturday and the FT on Saturday was all about, oh, this move is entirely about Trump odds. I'm not so sure of that. The data's been pretty good, and the cyclicals are working as well. So I see better data. I see cyclicals outperforming. I don't think the market is as agitated about the move in yields as the consensus is.
So is there any Trump trade in that rise in bond yield?
I think where you've seen the Trump trade really manifest itself is in the bank stocks. I mean, these banks have just been consistent leadership, basically going back to June, when it kind of seemed like, at least for the first time, the character of the race began to change. And, you know, we've done some work. What was the best group from Election Day 16 through the end of that year? It was KRE. It was. I don't think we're going to get that kind of same impact if Trump were to win here, because a lot of it has been pulled forward here. But certainly, I think that's been the manifestation.
But couldn't that be choose your narrative, given the fact that financials also had a good earnings season?
Yeah, I think. Let's remember the following. All year, 95% of financials have been in uptrends. Regardless of what the news is, expect the outcome to be in the direction of the trend. So whether we want to associate it to good data, to good earnings, to Trump odds, I think the bigger story is all of the internal work on the sector, and globally as well. I mean, even these European banks, where there's no election, are holding up remarkably well.
Do you want to finish on the rest of the world?
Yeah.
What does the rest of the world look like compared to what's developing here stateside?
I think there's this very antagonistic view on China here. And I just see it in my meetings. I see it internally. I see it externally, where you even kind of hypothesize that, hey, maybe China's getting better here. And you get a lot of pushback. I think the thing that has stood out to me kind of most pronounced is Chinese consumer discretionary is outperforming Chinese staples by a massive margin. When do you tend to see that? When you're coming out of a recession, or when the data is not going to get worse. And I wonder if that's the inflection there. I want to watch things like aluminum. I want to watch things like zinc. I want to watch European autos, European luxury. Can they dig in here on bad numbers, right? Stocks do not bottom on good numbers. They bottom on bad numbers. We have to not forget that. You had terrible numbers from European autos, European luxury. Can they bottom on that? is that some message that maybe rest of world will start to turn here?
Are you starting to see that sort of bleed into European optimism at a time where George Saravellis of Deutsche Bank put out a note saying basically the odds of negative rates are rising again? I mean, it's going back to this sort of deflationary cycle time.
Gosh, I hope not. But I do think if there's maybe one thing that's gone a little overlooked the last few weeks in Europe as the market's actually corrected, is European cyclicals have started to gain some foothold against European defensive. So if I was going to look for things that might suggest rest of world is gaining or could gain some economic momentum here, I'd look to the leadership, and I think the leadership is starting to look a little bit more pro-cyclical there for the first time all year.
We've been asking the question all week, have we seen that kitchen sink moment for the autos in Europe? How much more bad news can you throw at some of these names?
I've been asking that for a couple months, and clearly the answer has been no until maybe just recently here. I do think these European bond yields are important as well, because, I mean, remember, they've moved as well without the election impulse that we have here. So, again, just to say the move here in yield is all about the election, I think is a mistake.
Yeah, the UK's got its own problems right now, that's for sure. Chris, it's good to see you.
Great to see you.
Great to catch up. Thank you, sir. Chris Verrone of Strategas, a bad company, with an update on news elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of Apple down in the early trade 1%. The tech giant failed to impress investors with its quarterly earnings report. It predicted tepid growth for the holiday season. Apple also sparked fresh concern about revenue growth and lingering weakness in an intensely competitive Chinese market. It posted a decline in China revenue last quarter and fell short of estimates. Boeing and its leaders representing its largest unions have reached a tentative deal to end the strike that's now in its 7th week. The agreement would boost wages by 38% over 4 years and give workers a signing bonus of $12,000 if approved. The union urged its members to accept Boeing's offer and end the strike, warning they risk losing gains they've made after a couple of weeks of collective bargaining. The union plans to hold a vote on the proposal on Monday. And the blockbuster 2024 World Series lived up to the hype, that at least according to the ratings numbers reported by Fox Sports. An average of 15.8 million people tuned in each night across the series, with that number spiking up to 18.6 million for the decisive Game 5. That makes it the highest rated World Series since 2017, and also makes it a major boost from last year's series, which averaged just over 9 million viewers per game. The Dodgers will have their championship parade later this morning in downtown LA. And that's your brief. John.
Are they smashing windows this time and looting stores? Is that happening on the parade or just the night off?
I really hope not. I mean, you're right. It's crazy. And everybody agreed it was crazy. What the heck? You have like a good outcome. Go riot. Doesn't make any sense.
Makes no sense at all. Danny, thank you. We'll catch up with you in about 30 minutes' time. Up next on the program, the gender divide.
I'm going to do it whether the women like it or not. I'm going to protect them.
It actually is, I think, very offensive to women. He does not prioritize the freedom of women.
That conversation up next, live from New York this morning. Good morning. It is Payrolls Friday. Equity futures on the S&P 500 higher by 0.33%. In the bond market, yields up a single basis point. The 10-year 4.2947. Under surveillance this morning, the gender divide.
I want to protect the women of our country. I said, well, I'm going to do it whether the women like it or not. I'm going to protect them.
Donald Trump vowing to protect women. Kamala Harris snapping back.
It actually is, I think, very offensive to women in terms of not understanding their agency, their authority, their right, and their ability to make decisions about their own lives, including their own bodies. He is not going to be fighting for women's reproductive rights. He does not prioritize the freedom of women and the intelligence of women to make decisions about their own lives and bodies.
The gender divide at the epicenter of this year's U.S. election. Harris campaign officials touting higher voter turnout from women than men across battleground states, finding women making up 55% of early voters in swing states, a demographic the vice president performs much better in than the former president. Bloomberg's David Gura joins us around the table here in New York. David, good morning.
Good morning.
How important is this divide going to be this year?
Huge. I mean, we know that white women in particular are 30% of the electorate and they're reliable voters. They go to the polls on election day. So getting them to do that this year, for the Democratic Party, getting them to support Kamala Harris is a huge deal. And, I just look at this kind of gift that Donald Trump has given the Harris campaign. This is an issue that they really wanted to lean into, the Harris campaign wanted to lean into, and over these last few weeks, they've been kind of pulled in different directions. That comment from him, I think, brings up a lot of memories of 2016 and what Donald Trump said when he was a candidate then to Chris Matthews about punishing women who sought abortions. It kind of raises fresh this idea that reproductive rights are on the line in this election and kind of brings it back to where the Harris campaign wants it to be.
I'm glad you brought up white women. They're the largest voting demographic bloc. In 2016, 47% of white women voted for Trump compared to 45% for Hillary Clinton. Even more white women, though, voted for Trump in 2020. Do they not trend for him now in 2024?
I think that the Harris campaign sees them as a bloc they should have more of and should be able to bring to their side. But you bring up that history, and I think that it's very raw and real for the Democratic Party. I think there is the school of thought that you have a woman with a very viable shot at being the first female president. Why aren't more women supporting her? But I think it kind of speaks to the fact that there's still, a lot of women who did support Trump in the past maybe feel squarely like they should still again and are just having difficulty kind of bringing them over to the Democratic side. I had kind of deja vu. The Harris campaign came out and was saying, okay, we've got something we can hook into. We could talk about women's rights and independence. And then Mark Cuban comes out and basically says that Trump does not have strong, intelligent female supporters. And all of a sudden, people were thinking, okay, is this another deplorable moment where basically you have Democratic proxies coming out and insinuating that if a Republican woman votes for Donald Trump, she is somehow bad or not strong and intelligent. How much does that really set the campaign back? I don't know how much it sets them back, but this has to be deeply frustrating for the Harris campaign, both that remark and the garbage remark from President Biden. I think they'd be very keen to have, all of these surrogates and the incumbent president sort of sitting more on the sidelines than they have been. So, yes, we're talking about it. People are talking about it. But it's been this kind of ping-ponging back and forth over these last few weeks with remarks like this. Obviously, Mark Cuban tried to clean that up in the face of Trump's campaign chairwoman saying, in fact, they are strong women who are in this campaign. But yeah, both of these candidates continue to step in it, and it's not helping either one, I think, in these last few days.
There are some incredible women on the Trump campaign. I see more videos of Cuban than I do from Harris day to day at the moment, which is kind of bizarre.
Well, yeah, he's all over the Twitter sphere. But speaking of that comment, we never hear from Susie Wiles. We really don't. She doesn't tweet. She tweeted yesterday.
David Gura, it's good to see you, sir.
Good to see you as well.
Thank you. Rob Casey of Signum Global Advisors joins us now for more. Rob, we'd love your thoughts on this. Millions of people have already voted. Do we have any clarity whatsoever on how that vote has been breaking?
Yeah, John, team, really good to be with you. I mean, we have clarity in the sense that we have really good data coming out of the early vote. A number of states report, partisanship, gender, race breakdown. We can see it by county. The thing is, within that data, even though it's good data, we haven't seen a lot of clear trends. So women are turning out more than men. That's a good sign for Harris, but they're turning out about where they were turning out in 2020. So not a clear better or worse than the Biden-Trump matchup.
NBC. Oh, Rob, just to jump in there, NBC News Decision Desk has new female Democratic voters in Pennsylvania. They're seeing that influx. But the flip side of this is, what about the male vote? Because they see new male Republican voters in Arizona, two critical swing states.
Yeah, frankly, I think Arizona is where Harris is running weakest, and that's for two reasons. We're seeing her running weaker among Latino voters and much weaker among male voters, which is really a national trend. In the blue wall, though, Harris is less impacted by both of those, primarily because of the white women who David was just discussing. White women turning out in droves for Harris at a higher percentage and with a better margin for Harris than in 2020.
They're both going to be in Wisconsin today, Rob. How tight is that race?
It's really tight. It's really tight. At Signum, we feel good in our call that Harris will win the presidency. A lot of that is because we feel as though she's running clearly ahead in Michigan and Wisconsin. But across all of the swing states, if the polling today doesn't show clearly that they're tied, every poll that we're seeing is within the 4 points, which is the average margin of error in presidential cycles between 2000 and today. So all of these races are incredibly tight. But I do think it's fair to say Harris is leading, if anywhere, in Wisconsin and Michigan.
Rob, we keep talking about how tight these polls are, how it's really neck and neck. And yet there seems to be a growing conviction in the investors who we speak with that it's not going to be a contested election, that it's not going to drag on for a significant amount of time. And you can see this in the options markets, where basically the volatility peaks the day after the election and then it peters off with this idea that we'll have some sort of clear outcome or a sense. How is that correct? Is that your base case also?
It is our base case. We think we get a very clear result in the first 48 hours post-election. It may not be that the Associated Press is calling the election within 48 hours, but we do think that markets and most who are looking at the election most closely will have a very good sense, as we did in 2020, right? Betting markets moved to Biden about 80% as of Wednesday morning. So even though it took until Saturday for the Associated Press to call the 2020 election, markets essentially priced in a Biden win starting on Wednesday. We expect to see a similar result. I mean, you have to remember, in 2016 and in 2020, all of the swing states, essentially all of the swing states, broke for one candidate or the other. It was Trump, and then it was Biden. And we think very likely that there will be some polling error. It will affect most of the swing states almost equally, and thus that most of the swing states will break for one candidate or the other. So even if there are, outstanding legal challenges, et cetera, they're probably not going to be significant enough, and the margin won't be tight enough for them to matter a whole lot.
Rob, you said something there that was really important to me because I've heard it echoed by other people, that there probably is a polling error. What could that polling error be? Because a lot of people have been saying it feels like maybe something is just off with these polls.
Yeah, unfortunately, I don't have a very good answer in terms of direction because we really feel as though there will be polling error. I mean, there always is polling error. Polling was very good in 2022. There was still some error, 2 to 4 points. We have heard from clients a very strong belief that polling will underestimate Trump because it underestimated him in 2016. It underestimated him in 2020. I mean, we all remember that. The thing is, we've seen pollsters make a number of changes, both to their collection process and to their sampling process. And so we really think that, we probably will see a polling error if we're lucky, 2 to 4 points. If we're unlucky, 4 to 8 points. But it's really hard at this point to predict in what direction that polling error is going to land.
Rob, I think of 2016 in Michigan and how Hillary Clinton lost that vote by about 10,000 votes. So if the independent Jill Stein wasn't on the ballot, Hillary Clinton could have clinched Michigan. Is that what gives you confidence about Wisconsin and Michigan? Because RFK is still on the battle in those 2 key states?
Yeah, the third-party question is really interesting. Third-party candidates did hurt Clinton in 2016. They came back and hurt Trump in 2020. It is true that Jill Stein, especially in Michigan, is probably going to run beyond polling, and that's because she sort of serves as a proxy for Arab American voters and progressive Democrats who are very unhappy with the Biden administration's handling of the Middle East. Nonetheless, Anne-Marie, to your point, I mean, RFK remains on the ballot in Michigan and Wisconsin as hard as he's tried to get off of the ballot. He's polling it between 1.5 to 3 percentage points nationally still today. So I don't know who those people are who think they're still going to vote for RFK. They're certainly not paying attention to the news flow, given he's clearly dropped out and supported Trump, even though he remains on the ballot. I think it's also important to consider that the only third-party candidate who is on the ballot in all 7 of the swing states is Chase Oliver, the Libertarian. So he's going to pull more votes from the right wing as well. I mean, I don't want to overstate it. It's not a lot. I think third-party candidates are unlikely to make a huge impact in this race, but we're hearing a lot about Jill Stein, and I think it's important to look on the other side of the aisle on the ticket as well.
Rob, just quickly, a final word from you, sir. On election night, if there's one thing to watch, your election night guide, what's the one thing you'll look at?
Well, we're really hoping to get results from North Carolina early, most of the results from Georgia early. But if there's sort of one other thing, I would look at, is Kamala Harris outperforming in urban areas among all voters, but primarily Black and Latino voters and young voters. If she can outperform there as well as outperform among white women, the election is hers.
Rob Casey of Signum Global Advisors, thank you. Giving Harris the edge. In about an hour from now, we'll have a conversation with someone who will say completely the opposite. We'll catch up with Mr. Boltansky over at BTIG, who believes that maybe Trump has the edge. So I'm not sure how much out will be this morning. Equity futures on the S&P 500 doing OK. Apple slightly softer. We're down about 1% in the pre-market. Coming up next on this programme, we'll catch up with Tom Forte of Maxim Group on the latest results from Apple. In the bond market, your 2-year and 10-year are coming off the back of a major monthly move. 50 basis points higher on 2s and 10s, and we add some. A single basis point on this first trading day of November. Your 10-year 429, your 2-year up a single basis point at 418. The jobs report 2 hours and 5 minutes away. The estimate in our survey, 100K. From New York, this is Bloomberg. The payrolls report 2 hours away. The median estimate in our survey, 100K. The scores look like this. Equity futures on the S&P 500, on the Nasdaq, on a Russell. On the S&P, up 1/3%. On the Nasdaq 100, up by 0.4%. Getting a lift from Amazon. We'll talk about that earnings a little bit later on this morning. Yesterday, that decline snapped the winning streak on a monthly basis on the S&P 500. The first monthly loss on the S&P 500 going back to April. Switch at the board and get to the bond market. 2-year and 10-year up around 50 basis points apiece in October. This November, up a single basis point on a 2-year, 4.1826. On a 10-year, up a single basis point to 4.2947. We've had a series of upside surprises when it comes to the labour market. Jobless claims yesterday, the right kind of downside surprise. We've had a month of preparing for a weaker than expected jobs number at 8:30 Eastern time. And all of a sudden, you start to get this thought. Could it be stronger than everyone's thinking?
And not just stronger, but if it is stronger, it means that probably people can't discount it because they've already explained all the reasons why it should be weak and why you have to strip out thousands and thousands of jobs for the effect of the strike and the hurricane. So what's the response? It's unclear and probably unlikely that the Fed's not going to cut for 25 basis points. They could say, look at the beige book, look at certain aspects of the JOLTS report. Nonetheless, it raises questions about just how much momentum is in this economy that can continue, regardless of how much really turmoil happens.
Noise versus signal. Noise, weakness. Signal, strength. The cheat guide for 8:30 Eastern time, apparently. Switch at the board and get to the commodity market. WTI and Brent crude looks like this. We're up by 2% on Brent, 2% on WTI. A report from Axios citing 2 Israeli sources that it did not identify that Iran might be preparing to attack Israel from Iraqi territory in the coming days.
This would be Iranian authorities basically using their proxies to go after Israel. This was leaked out to Axios, and potentially this coming in a few days immediately hit the oil market. The question I have, would Iran want to do this before a consequential U.S. presidential election? I thought the idea is they potentially want to see things in the U.S. be basically, does the U.S. decide and then recalibrate? If this came soon, then this would be something very difficult for this administration to handle.
More on this story a little bit later. Brent crude at 74.25. It would be carried out using drones and ballistic missiles. A surprise, a real surprise for this market, I think, in the last few hours or so. And a surveillance this morning, Boeing and union leaders reaching a tentative agreement to end a 7-week-long strike. The Machinists Union saying the latest proposal would boost wages by 38% over 4 years and give workers a $12,000 signing bonus if it's approved. The vote is set for Monday. The stock is up by 2%. We have seen this movie already before in the last few weeks.
Right. And basically now you have a vote that's coming up in a number of days at the same time as right before the election, November 4th, they're going to have that vote. This, to me, from the union was really interesting. In every negotiation and strike, there is a point where we have extracted everything that we can in bargaining. And by withholding our labor, we are at that point now and risk a regressive or lesser offer in the future. And I have to wonder how much this was affected by the fact that they're not getting paid and they'd have no health care. And that basically people are saying, all right, this has got to stop.
And third time's a charm. In September, 94% of those union workers said no. Then they came back last week. 64% voted no. They need to get this at least 50%, basically. More than 50%, overwhelmingly, they need to get to say yes, bring those numbers down. They say this is time to lock in these gains and declare victory. If they don't do it now, I don't know what else Boeing is willing to give out.
There's a pretty strong feeling they're hurting themselves more than they're helping, at the moment at least, and that's why the stock is up by 2% of the pre-market. We'll see. We'll see in a few days. Let's turn to China. The latest data out of the world's second largest economy indicating the economy has stabilized somewhat following Beijing's stimulus push. Official and private measures of factory activity in October exceeding analyst expectations, with home sales seeing their first rise this year. Are we seeing the early signs of things starting to inflect higher, bounce, bottom out?
People think that, yes, Chris Verrone was just saying yes. My issue is, and this is really an honest question, is this just basically stimulating the same areas that they could stimulate before, which is the housing and the manufacturing sectors? People want to understand how much firepower the consumer has to go out and start to really spend to expand the economy. And without that, how sustainable, how virtuous of a cycle can this kind of stimulus have? We'll have to see on November 8th when they actually come out with the big bazooka or not, depending on who wins the U.S. election, evidently. But right now, it does seem like there are signs that things are turning around.
And when it comes to the U.S. election, Goldman Sachs has a note saying that potentially that means China is going to have to move towards internal domestic consumption. They're going to have to, if there's a 20% tariff in their base case, if it's on Trump. But Xi Jinping released a speech today. He said China's entering a period where strategic opportunities as well as risks and challenges coexist and, quote, unexpected factors are rising. Didn't name the U.S. election, but clearly we know what he's talking about.
The earnings numbers out of China haven't been great across a range of industries. We've seen this from LVMH in luxury. We saw it from Starbucks. We saw it from Apple as well overnight. Just a bit of weakness there that we'll talk about in just a moment. Let's turn to tech and talk about Amazon before we get to Apple. Reporting third quarter earnings that beat expectations. The company's AWS cloud division, online retail operation and advertising business all showing strong growth, driving total revenue up double digits, up 11%. That stock is up more than 6% this morning, a trifecta of beats from Amazon.
And this overwhelmed the possibility of them spending $75 billion on capital expenditures this year. If some of the other big tech companies had come out with such a massive number, they would have been punished if they weren't showing the path to profitability. But what Amazon did was they showed the path to profitability with an increase in their AWS platform, which had been flagging, and just operating on all cylinders. So suddenly it's fine. And that, I think, is the big takeaway from this earnings cycle of the big tech. If you show the path to profitability, if you show us the money, by all means, spend away. But if you're not so sure.
It's hard to bet against certain parts of the US economy when the biggest cash machines on the planet are delivering a major capex boom at this very moment. And you're seeing it from company to company.
That, I think, is one of the major themes that will carry out, because you're seeing that and what kind of jobs that gets created, that what kind of issues is opportunities for investments, as we were talking about with respect to private capital. How much is that the overlay on an economy that might be tepid in certain pockets? But this is the thing that's going to really drive it forward.
Amazon's up by 6% in early trading. Elsewhere in big tech, Apple shares lower following fourth quarter results. Tom Forte of Maxim Group highlighting concerns around the iPhone 16, writing, if this is an AI-fueled supercycle, it is off to a very slow start, given the performance in the September quarter and December quarter sales guidance for only low to mid-single-digit growth. Tom joins us now for more. Tom, welcome to the program, sir. What's going wrong over at Apple?
Well, what's going wrong is that the AI-fueled supercycle at least does not look like it's a supercycle. So there's two data points that are muddying the water. The first was the mismatch of the hardware and software rollout to the extent that they launched the iPhone 16, but only recently in the US did they start rolling out software, Apple Intelligence, and it remains to be seen when they're going to roll that out and if they're going to roll that out in China. The other data point muddying the waters is China. So you have a weak macroeconomic environment there, and that's negatively impacting Apple's sales, which is 15%, give or take, of their total revenue. So if there's a super cycle, it's surely off to a very slow start.
Tom, why wouldn't it be just a super cycle delayed, given that we know at some point the AI goodies are just around the corner? Why wouldn't you just assume that this is a super cycle upgrade delayed?
So if you look at the analysis we've done, where we were anticipating that they would get essentially half the boost they got for the 5G supercycle, that analysis suggested that iPhone sales would be up nearly 12% in fiscal 25. They reported 5.5% growth in the December quarter. They guided to that low single digit to mid single digit total revenue. They indicated services would grow at about 12.9%, consistent with where it grew in 24. So that leaves us at, again, around 5.5 for the iPhone, which doesn't feel like a super cycle.
Tom, are we watching them fail AI? Or they basically fail the rollout of it in a way that really can be tangible and juice that kind of replacement super cycle?
Yeah, so I'll go recent news. So it does feel a little bit like the fifth inning of the Yankees earlier this week, where they had a great idea with Apple Intelligence, but were not able to execute on it, have made multiple mistakes with the rollout. And yes, I think that is resulting in, on a relative basis, they're underperforming their big tech peers when it comes to exploiting AI.
Tom, let me guess, you're a Red Sox fan or a Mets fan. Either way, how much can we say?
Yes, okay.
You're a Mets fan?
Cubs.
All right. Well, Tom, I am curious about, who the Dodgers are in this scenario. And I see Anne-Marie shaking her head. But in the fifth inning, who's taking over for Apple?
So I think Amazon's the Dodgers as far as who's best exploiting artificial intelligence. Who's taking over for Apple, though, is the Chinese smartphone players are doing much better. And I think that's a challenge for Amazon. Perhaps the parallel there is Boyd and Tesla for what you're seeing in EVs. But as far as who's doing the best and who's best positioned to exploit AI, I think that's Amazon.
Tom, I'm going to ignore the fact that you're pouring salt on my wounds this morning. I want to stay in China. Does Apple have a problem with this AI timeline and getting people, consumers in China excited, or are they just keep losing ground to these national champions?
I think it's AI timeline. And I think that Apple Intelligence, it's possible it'll never be in China. So when you think about the influence of the government there, why would they want Apple to roll it out? Tim Cook's amazing, part CEO, part diplomat. So I'm curious to see how it plays out. But I think that hurdle is very challenging for the company.
Even if they team up with a local partner?
So let's say they team up with a local partner and provide either the Chinese version of Apple Intelligence or some sort of light version. I think that the challenge that we forget is that there's essentially a new iPhone unit every fall. So if they don't crush the sales at the launch and they don't crush the sales in the December quarter, the consumer starts waiting for the next one, AI or not. So that could result in, an even slower developing super cycle.
Dan Ives is very quiet this morning, Tom. I'll reach out to him and we'll try and make that conversation happen one day. Tom Forte there of Maxim Group. Hey, Tom, appreciate it. Sir, thank you. I think we've been far too kind to Aaron Boone if he's the Tim Cook of this situation. Don't you think?
All I can say is,
you guys are killing me this morning.
Putting that aside, I think you just want to see Dan Ives come in with a skinny tie and a black suit and come in and say, all right, this wasn't great.
I mean, Apple's only down 1%, so maybe now's not the moment.
Yeah, I don't think he's going to do it.
It's not the moment. Equity futures on the S&P up by 1/3 of 1% this morning. No real drama there. With an update on stories elsewhere with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John, a recap on some oil major earnings. Chevron and Exxon both delivering better than expected third quarter results. Both shares higher pre-market. Higher oil production from the U.S. Permian Basin helped offset a drop in crude prices and a weak quarter for refining. Chevron indicated that potential job cuts in the U.S. are to come as part of a new cost-cutting plan. The CEO says $3 billion in cost savings will come from asset sales and the use of new technology and workflow changes. Intel shares, those are surging pre-market, 5.5% more than that in the pre-market trade. They gave a fourth quarter revenue forecast slightly above estimates. Intel CEO Pat Gelsinger sat down with Bloomberg's Ed Ludlow to highlight the turnaround.
We laid out a strategy. We reaffirmed that with our board of directors. And obviously, as we've taken these steps this quarter and restructuring and getting our costs where they need to be, we have the capacity to go on the journey.
In the prior quarter, Intel cut jobs, slashed its spending, and suspended investor payouts. Elon Musk staving off a challenge to his daily $1 million giveaway to voters ahead of Tuesday's election. A Pennsylvania state judge saying the case is on hold while a federal court decides whether to take the case. The hearing came after Philadelphia district attorney sued Musk over the sweepstakes, saying it violated state lottery and consumer protection law. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. They're running out of time, aren't they, to deal with that? The election's a few days away.
Well, if they want to deal with it before the election, it's on Tuesday, so they better get moving. But people are receiving those checks that signed up.
It's just amazing. Absolutely amazing. Up next on this program, looking for signs of weakness.
The pendulum had swung a bit too far. People got a little bit too breathless over a couple of weak months of jobs data. We're not deteriorating.
We're not deteriorating. The data so far in the labour market for the month of October has been pretty decent. We're looking ahead to payrolls next on the programme. Scores this morning look like this. Equity futures up by 1/3 of 1% following a very mild month of losses in October. As we kick off November, we resume the climb on Treasury yields up a single basis point, approaching 430 once again at 429.67. I just want to finish on crude. It's up 2%. We're back through 70 on WTI. This Axios report is a bit of a head-scratcher, citing two Israeli sources it didn't identify that Iran might be preparing to attack Israel from Iraqi territory. So there's a premium being built back into the commodity market. WTI and Brent crude up by something like 2%. Under surveillance this morning, we're looking for signs of weakness.
You look at the job openings data from where it was when the labor market was tightest, you have to say there's been some cooling. So I think in that regard, they're fine. the pendulum had swung a bit too far. People got a little bit too breathless over a couple of months of jobs data. We're not deteriorating.
So here's the latest. The payrolls report dropping in less than 2 hours after a month full of disruptions. The Federal Reserve tasked with separating the signal from the noise going into next week's policy meeting. Sarah House of Wells Fargo expecting a sharp slowdown, writing, while the October payroll print will likely understate the current position of the jobs market, we continue to see strains under the surface that point to the jobs market softening further in the near term. Sarah joins us now for more. So Sarah, welcome to the programme. The task this month is to separate the signal from the noise. How will you identify real cyclical weakness given the disruptions we've seen through this month?
Sure. So I think there's a couple ways we can do this. So one is I think we're going to be looking more at the unemployment rate, given that that's going to be more insulated from some of the strike effects as well as some of the hurricane effects. So if you were employed just not at work either due to the weather or a labor dispute, you're still counted as employed in the household survey. And then other places I'll be looking is, one, what about the revision? So we had a very nice positive net revision last month, but do we see the first consecutive back-to-back positive net revisions in 2 years? And then also I think you can still maybe parse out some of the effects from the industry data. So if you're looking at what industries are most exposed to, I think, some of the hurricane effects, things like construction, leisure and hospitality, we can set aside manufacturing, but what happened in the other industries that maybe give us a better sense of how the trend is holding up right now.
Sarah, is this the least important jobs report ever just simply because of how muddy it is?
No, I don't think so, because if you look at the strike effects, I think those are going to be pretty easy to parse out. So that's going to account for roughly 41,000 jobs. So you can basically add that back in. The hurricane numbers are going to be a little bit messier, but there's still just a wealth of data in this report. So there's a lot of information in the household survey. There's a lot of information you can get from even the subsectors, things like temporary help employment. And so while I think it's maybe not going to be the most straightforward report we've had in a while, I still think that it's going to be important, especially just when you think about where the Fed is in its nascent cutting cycle. I think it could still carry a lot of weight.
Sarah, if the unemployment rate does come in at 4.1%, as most people do seem to expect, there is a sense that the economy is still strong on a collective level, even if there are these pockets of weakness, as you highlight, that are showing up in a number of the surveys. How do you parse out whether this is just simply bifurcated economies within the overarching economy that are having recessions, that are having booms, and that aggregate out to something that's pretty good, even if not great?
Yeah, so when we look at the unemployment rate, so if it stays at 4.1%, so yes, this is up from the start of the year, it's up from its cycle low, but overall that still indicates a pretty solid state of the labor market. In terms of the bifurcation of, are we seeing stresses? I think one area we've seen is that, it's a really good labor market still for those workers who have a job, as we see layoffs remain very low, but we have seen it become more difficult if you either were one of the unfortunate workers to get laid off or you're coming back into the workforce. It has gotten a lot harder. And then I'd also say we see some bifurcation in terms of where you still have some of the outsized demand for. It tends to be more in your skilled trades, vocational, some of the lower skilled, leisure and hospitality jobs. That's where we've seen wage growth slow most markedly. And so you are starting to see a split between what's happening with wage growth between some of your lower paid workers, whereas wage growth has been holding up for some of the higher paying industries. So some bifurcation there, even if, again, in the aggregate, we're still looking at a pretty decent jobs market right now.
Sarah, we talked a lot about the transitory factors when it comes to things like the hurricane, maybe the Boeing strike. What cyclical factors are you worried about right now in the labor market?
Yeah, so I'm still concerned, I think, about the overall stance of borrowing rates. So the fact that, yes, even as we see the Fed cutting, so rates remain elevated, certainly where they were versus the early 2020s, but even relative to the last cycle. And so there's still some strain on some businesses in terms of that interest expense, where they're having to trim around the edges in terms of their employment. So while we see layoffs remain low, there's also not a lot of hiring going on right now. So you have businesses essentially in in a holding pattern. And so while that points to some stability for now, it also keeps us in, I think, a precarious position where you don't need to see much of a shock in order to see further deterioration there. So those are some of the things we're looking at.
The lowest estimate comes from Bloomberg Economics at -10 from their model forecasting, but they say it could be anywhere between -50,000 to upward of adding 90,000. What do you think would be more of a surprise to this market, a negative print or something that actually comes in closer to that surprise September report we got?
Yeah, so I think the risks around this report in terms of interpretation or what we can take away from it would be if you get a much stronger than expected payroll reprint, where again, we know there's a depressing effect from the strikes. We know there's at least some depressing effect from the hurricanes that we saw over the survey period, as well as just the intermeeting period. And so I think if you were to see another strong payroll print despite those factors, I think that would be pretty telling in that we are seeing, I think, more signs of maybe labor conditions stabilizing.
Sarah, Neil Richardson of ADP said something I thought was really interesting, that a number of employers are waiting until after the election in order to really decide whether or not they're going to hire people, whether they're going to expand, and what the conditions will be. They just want certainty. How much are you factoring that into some of your models?
Yeah, so we've looked at that before, and you really don't see a discernible difference between hiring pre and post election. So I certainly wouldn't discount that some employers are thinking about it, but in terms of the aggregate, we haven't really seen a lot of evidence that moves the needle. So maybe it's having some effect, but I don't necessarily think that that's what's been behind, some of the, setting September aside, maybe some of the weaker payroll prints that we saw in the summer.
Hey, Sarah, good to hear from you. Sarah House there of Wells Fargo on this payrolls Friday. Got no idea what's going to happen at 8:30 Eastern, so let's put that out there. I actually think it's going to be really interesting to see how this market responds to it. I have, relatively speaking, a high degree of confidence in how this market will respond to a strong print. There will be this assumption that things must be really strong. If it's weak, we're going to have a much bigger debate about whether that is just noise or whether there is some real cyclical weakness, which is essentially the point that Sarah's making in that conversation.
Yeah, and trying to strip out just how much are these effects, and then do you make it an excuse and say, okay, well, that doesn't really take away some of the huge rise that we've seen in yields for myriad reasons, right? It's not just simply the economic data. But one messy data point that people have been throwing shade at for a long time isn't going to change the narrative in and of itself. It might highlight and crystallize it, and you might see some whipsawing, but I don't see some sort of wholesale feeling, okay, we're either off to the races or we're down in the dumps.
Don't you get the feeling that people are looking for an excuse to buy bonds?
Oh, I think that they're
Who
looking...
wants to step in front of this going into next week? Not many people do. BMO's Ian Lingon's written about it all week. He doesn't see much reason for yields to go much higher from here, but doesn't want to step in at the moment because of the event risk next week. How will we respond to a weaker payrolls report? I've got much greater confidence in how we'll respond to strength. A weaker payrolls report, I'm still not so sure. I'm not so sure you can sit here with any real degree of confidence and say, yeah, we'll just sort of shoot that away and say that's all just noise. We'll see.
I would guess that long-term investors who just believe that the trend will reassert itself regardless of what happens next week will probably use it as an opportunity, though. Just because, how many people have you heard say you had another opportunity? If you missed it the first time, well, guess what? It's back on.
We'll speak to another one of those in just a moment. Priya Misra of JPMorgan Asset Management joining us on the programme. Isaac Boltansky of BTIG, Alan Zentner of Morgan Stanley, Rob Sockin of Citi. All of that and a whole lot more in the second hour of Bloomberg Surveillance.
The people who are going to decide this election, as of today, have not made up their mind yet.
When I talk to long-only investors, they are confused about what is going to happen on Tuesday.
The idea that either candidate is going to get everything on their wish list, I think, is a limiting factor.
There is still so much unknown about exactly which policies will get implemented.
Anyone who tells you they know who's going to win doesn't know what they're talking about.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The payrolls report, 90 minutes away. The scores look like this. Equity futures on the S&P 500 positive by 0.4%. Similar move on the Nasdaq 100, higher by 0.45 in the bond market following a 50 basis point pop on a 2-year and a 10-year through October. We're up another basis point. The 2-year 418.47, the 10-year just short of 430 at 429.27. The estimates look like this: the median 100K, the high Mizuho 180, the low Bloomberg Economics negative 10,000.
So basically, we have no clue. We have no clue about the jobs number. We have no clue about the election. We have no clue about exactly how the market will even respond to said jobs report, as you were just pointing out, because of some of the other issues that are here. As Julian Emanuel said, this is peak uncertainty. And it raises a question of what kind of signal we can get from any kind of trading of any type, simply because people are so jittery and don't necessarily have a very clear framework or conviction right now.
The jobs reports have been really difficult the past few months anyway, because even Jay Powell himself told us to mentally adjust to the lower end. Bloomberg Economics thinks it's actually even more than 60 or 70,000 you have to swipe off based on basically not great data collection. They say it's more like 91,000. So already these numbers were difficult to understand and digest. Then you add in 2 hurricanes and Boeing. It's very challenging when this market comes out at 8:30.
Hurricane noise, what hurricane noise? Jobless claims, 216 yesterday, ADP upside surprise, consumer confidence, the conference board, the labor differential improves. After deteriorating for months and months and months, in the month of October, it improves.
Which is the reason why you get this feeling. Maybe we could get more of an upside surprise, and that would be treated more realistically in markets, simply because you are backing out all the weakness anyway, and you're still getting this number. What's interesting is whether people will look past it and say the Fed will still be on a preset course with 25 basis points every meeting, in part because of the employment cost index that we got yesterday. And just employment cost isn't necessarily surging. So it comes back to, do we start to care once again about inflation that seems to have been left for dead as a talking point for the Federal Reserve?
The Federal Reserve decision next Thursday. Equity futures this morning up 0.4% on the S&P 500. Coming up this hour, we'll catch up with Priya Misra of JPMorgan Asset Management on the possible path to higher rates. Boltansky of BTIG as the presidential election enters its final days. And we'll speak to Zentner of Morgan Stanley on what could be a messy payrolls report. We begin this hour ahead of a busy stretch for financial markets worldwide. The US payrolls report coming at 8:30 Eastern Time, election day on Tuesday, and a Fed decision 2 days later. Priya Misra of JPMorgan writing this: a strong payrolls report and a Republican sweep will mean higher rates. And at some point, that could pressure risk assets. Priya joins us now for more. Priya, good morning.
Morning.
Seen some higher rates, 50 basis points higher over the last month. Data or politics? What was the big driver?
I would say both. So I think the move in the 10-year from 3.65 to 4% was really data. Because remember, the prior 2 months, we had these weaker payroll reports. So there was this fear, and I think I talked about it the last couple of payroll reports here with you, that we were in a soft landing. Every market's pricing in the soft landing. But then if you look at the July and the August payroll report, there was this notable deceleration. Then we get the last payroll report with this, with revisions, with this really strong 250, and we took that downside surprise out of the market. But I would say the last 25, 30 basis points is the market starting to price in re-acceleration risk. You get a strong report today, and I would say we have to adjust for that hurricane strike impact. You get, I would say anything above 150, 200,000 is going to make the market feel, well, forget downside risk, we're actually re-accelerating. That's what the market's pricing in. And then, as you know, we have this big election coming up. I think that the market's starting to price in a re-acceleration, supply concerns. It's the combination of the two. The last 25 basis points, I think, is much more that rather than that downside risk being taken out.
What would upset the easing bias of the Federal Reserve? Any kind of number today that could do that?
I don't think so. I think, they're telling us they're normalizing. We're at 5% on Fed funds. I think if we were at 4, we should be having that debate. Because, what's neutral? If the economy is actually fine, if we're not decelerating any further. Now, I would argue, actually, if you look below the surface, there is this bifurcated economy. I know you all have been talking about it. The signals are mixed. We can all look at whatever, the data will sort of fit any story right now. Are we re-accelerating? Are we decelerating? The data is mixed because we're in a soft landing. And, soft landings are rare, so we don't actually know how to price that in. So, I would say for the Fed, let's look at inflation. They told us very clearly that 50 basis points, which I actually think was inflation, and the payroll payroll slowdown, but the Fed said it's inflation. Watch ECI, now wages today is going to be impacted by the hurricane. So I'm less looking at wages. Look at PCE, CPI. I think it allows them to cut a couple of 25s. If the economy is actually not showing any signs of deceleration or actually re-accelerating, they might be stopping earlier than what's priced in. But, I think the next few cuts are sort of baked in the cake.
You said something fascinating there. You said there's supply issues also coming with respect to the election. You have 3-year auction coming up before the election. You've got a 10-year auction the day of. I mean, you have all of these bond supply that's coming out at a time where potentially we could have a whole deal of uncertainty, the risk of re-acceleration, and a whole host of investors who don't want to get involved and step in front of a train before an election that potentially could be consequential. How messy could these be?
So the market has created value. When we look at rates, that's the one market that's pricing. Look at that neutral rate priced in by the market has gone up above 350. It's like closer to 375. So the market has moved, I think, pricing in the debt issues. I mean, we all look at the Trump trade or the red sweep trade, and we look at 2016, nobody really was talking about the debt. I think you have always talked about the debt issue. But even you were not saying, isn't that a big problem? I think the market is so different on inflation, on fiscal, and that's why I think these term premiums have risen. So can the auctions be risk events? Absolutely. I think every auction, I've never had, when I was a treasury analyst, people care so much about treasury auctions, which was great as a treasury analyst, but it's because these are risk events, they're market clearing events. I think they will all be risk events. What we'll be looking at is how much actually increase in debt are we talking about? Where is it being spent? Is productivity picking up? If not, I think we should think about this market as a general equilibrium sense. As rates rise, and if it's a real rate increase, it's absolutely going to crowd out investment. It's going to have an impact on every other market if these 10-year rates keep rising.
Okay, there's a lot to unpack, especially with the fact that you were once an analyst and head of a group analyzing things, and now you're buying. And a question of whether you have conviction to buy at a time, let's say we get a downside surprise, let's say there is a sense of weakness. Do you have conviction that the traditional fundamentals of the bond market will still be in play and that it's not going to be this overlay of deficit concerns that I've had for a very long time and suddenly have become much more center stage?
Great question. Simple answer, no. I don't have a whole lot of conviction on duration. If I look at spread sectors, we're in a soft landing. I mean, you look at the top-down data, I talked about it's mixed. Look at the bottom-up data. There's absolutely bifurcation in companies, but overall, EBITDA is growing. Companies are not re-levering. So we like high-quality spread product. For duration, the reason I have said it makes sense to own duration is it's giving you some yield. It's giving you hedge protection. That hedge starts to go away. If we have significantly more debt, I'm not sure we could be back in the 2022 timeframe where the hedge between treasuries and risk assets went the other way. So I would stay away from duration. We're very close to home on duration. Once the election uncertainty, which I hope for all our sakes is gone by next week, that we know what the outlook of what government will look like, at that point we can start to say our correlation's back. I think if you are looking at a lot more supply coming in, we should stay away from duration, but think about spread product. Because the economy, fundamentally, companies and a large part of consumers are very strong.
Priya, when it comes to the yield, why do people say it's a Trump trade if both Harris is also talking about spending as well as the former president?
I think the numbers are slightly different in terms of how much increase in deficit will happen. The Center for Responsible Budget said $7 trillion over 10 years versus $3 trillion. So there's some of that. The other one is, the chance of a blue sweep, just looking at polls seems a lot lower than a red sweep. So I think people are pricing in the conditional probability that if you get a Trump presidency, then you might get a red sweep, in which case they can get a lot more on the fiscal front. So I think as people are projecting these supply numbers, it's much higher in one.
Because if they get a Republican Senate, you're going to get all those tax cuts potentially. Exactly. So what happens if it is a red sweep? How much higher do these yields go?
I think they'll go, the instinctive reaction is people look at 2016. Now, I would argue we've actually already sold off. But if you look from 2016 to a month out, that's a big increase in rates. And so I think the knee-jerk reaction will be much higher rates. I'm actually more interested in risk assets because I think risk assets, which have done great, S&P's up 20% this year, are going to look at rates and say, okay, that's going to hurt. We all expect the entire soft landing is contingent on the Fed cutting rates. They can cut a few more times, but if you're going to get a lot of fiscal stimulus, they're not cutting anymore. So I think risk assets, then we'll get a little more nervous on risk assets. If rates rise, I would say 10-year rates above 450 is going to be a problem for risk assets.
Do you include credit in that?
I would. I think it's not as high beta, but will high yield, that is so tight, will high yield start to impact if stocks start to struggle? Yes, and then at some point it's going to affect IG. I do think IG, when I look at company debt levels, they're not high, interest coverage is good. So I think IG might be a little more insulated, but you know, the technicals have been keeping IG spreads, investment grade spreads really tight, and those technicals can step away as well, because why do I think locking in fixed income at 6% is great if the Treasury itself is closer to 5%?
We had a guest from Morgan Stanley recently who suggested that maybe IG could trade through Treasury yields if you really started to get concerned. Do you disagree?
I struggle with that. I mean, you look at other countries that have had debt issues, and maybe the US is that special. But if the government spread is a certain amount, I would say every corporate should be a spread on that. Now, we can say it could be a tighter spread, and I think the market's reflecting how tight investment-grade corporate spreads are. But the through I struggle with, I think if you can get risk-free rate at 4.5, you're going to want a little bit more to take on a less liquid, higher credit risk product.
Priya, it's good to see you. We'll see you again on election night. Priya Misra of JPMorgan Asset Management with an update on news and stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Amazon reported strong quarterly earnings. You can see the reaction there. Shares higher at 6.5% in the pre-market. Its AWS cloud division continued to regain momentum during the third quarter. It recovered from a record low sales growth last year. Its online retail sales, those also grew by double digits. So too did revenue at Amazon's fast-growing ad business. Amazon also projected strong growth in the quarter ending in December. Japanese banking giant Nomura Bank announced that its CEO and other top leaders will take a pay cut after the firm admitted to an employee manipulating the Japanese bond market. Less than an hour after that announcement, local news reported that a former Nomura employee was arrested on suspicion of robbery and attempted murder of elderly clients. The scandals overshadow upbeat earnings reported today, where Nomura beat across the board in its quarterly performance. Economists at Goldman Sachs are cautioning that Donald Trump's proposed tariffs would shift China's approach to stimulus. They said that the tariffs would force Beijing to stimulate domestic demand and focus in on the consumer. China has identified shrinking demand as a key challenge since 2021 and repeatedly vowed to promote consumption. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the last big push.
We're here because we're fighting for a democracy. Fighting for a democracy.
If we can keep that cheating down, we're going to have a tremendous victory.
That conversation up next, live from New York City this morning. Good morning. The jobs number 1 hour and about 15 minutes away. Going into that, equity futures positive by 0.4% on the S&P 500. Under surveillance this morning, the last big push.
At the top of my list is bringing down your cost of living. That will be my focus every single day as president. I will give a middle-class tax cut to over 100 million Americans. We're here because we're fighting for a democracy.
I think we're leading by a lot. And if we can keep that cheating down, because they're a bunch of cheats, if we can keep that cheating down, we're going to have a tremendous victory.
So here's the latest. Both candidates holding their final campaign events heading into the last weekend before Election Day. More than 60 million voters already casting their ballots in early voting, equaling around 40% of the total vote back in 2020. Boltansky of BTIG writing, the election appears to be effectively tied, with each of the swing state polls inside the margin of error. With that being said, we still view Trump as a very slight favourite to win the White House. Isaac joins us now for more. Isaac, welcome back, buddy. Let's get to that final point. Why you believe still that Trump has the edge here?
Look, I think that we just need a mental model to enter the election season. I think that so many of these data points can become a choose your own adventure, and I think you can get caught in some of these headlines and some of the narratives. Instead, I've tried to just focus on what impacts those swing state voters and what those swing state voters say is going to lead to them choosing who they vote for. And thus far, they've continued to say the economy and immigration. So, look, that's my mental model. I can make a case for Harris, of course. This is effectively a tied race. But I needed to have some framing device for how to think about who's going to show up at the polls in those 7 states that are ultimately going to decide the election.
Tony Fabrizio would agree with you. He's the chief pollster in the Trump camp. And there's an Axios scoop that said the internal memo right now circulating the Trump world is, quote, President Trump is on the verge. Is this for internal consumption, though, Isaac? Is this for external?
Anne-Marie, I just feel like so much of this right now is we need something to talk about. We've got 110 hours until the polls close in Pennsylvania. Who's counting, right? But we've got 110 hours, and we've got to have something that we can talk about, because the fact is the election is close. It's going to be tight all the way through the wire, and we're probably going to have litigation thereafter. So we need something to talk about, which is why I think we're spending a fair amount of time talking about internal polls again, and we're talking about early voting data, just because we're grasping for some semblance of stability in what is going to be a pretty volatile few days.
Well, let's talk about the early voting data. What are you seeing? The NBC News Decision Desk has some analysis on state voter data, and they're saying there's been new female Democratic voters in Pennsylvania, but new male registered Republican voters in Arizona. How are you sifting through all of this?
I ultimately think that this is a wash. I think that what I've seen so far is Republicans are able to hang their hat on the fact that more Republicans are early voting than ever before. And when you talk to Republican strategists, that's what they're excited about. But look, Democrats are incredibly excited about the gender gap, and they're seeing more women voting in some of the swing states where you have that data. So both camps are able to keep on their talking points. I ultimately look at it as a wash. I think that first and foremost, early voting has never been a good predictor, right? I looked in 2016, early voting in West Virginia showed that Democrats were voting 12% more than Republicans. Republicans ended up winning West Virginia by 40 points. So it's never been a good predictor. And plus, just because you're a Democrat going to the polls doesn't necessarily mean that you're voting for Harris and vice versa. And so I've been trying to downplay the impact and actual predictive power of the early voting data.
I'd love to get your thoughts on some unforced errors we've seen from both sides of these campaigns. Donald Trump, when it comes to the Madison Square Garden and the comedian who wasn't very funny. And then, of course, the sitting president and his gaffe. And I'm pretty shocked, and I'd love to get your thoughts on why they're willing to let him go out to the critical swing state of Pennsylvania today.
Well, look, I think that ultimately it is hard to tell a president not to do something. They get that cool Air Force One jacket, and they can tell the plane when to take off. So they have their own authority there, right? And I think that's difficult to sideline a president, especially in Pennsylvania, where he continues to poll well, even with some of the gaffes. Look, this has been an abnormal campaign from the jump. There's been nothing about this that is standard or typical. So why wouldn't we have these honestly pretty unimaginable gaffes at the home stretch here?
As we fill the next 110 hours with a presumable analysis of something that we can't really foresee, I am curious, and I want to ask you the same question I asked Rob Casey. There seems to be a consensus right now in markets building that we will have a result the next day, or at least within the next 48 hours. And if you look at options, at volatility metrics, it shows it really dying down after those initial first days. Do you think the market is overly complacent about the idea of a contested election or some sort of drawn-out process?
I don't. And I'll tell you this. The conventional wisdom in D.C. now is that it's going to take weeks upon weeks and to get clarity on this. And I have generally faded conventional wisdom. I think that when you peel back the onion here, you can see that a number of these states have actually taken steps to expedite their processing of ballots. And furthermore, and this is a big deal, I don't think we're going to have as many mail-in ballots this time. We're not in the middle of a pandemic. So I put those two things together and say, I think that we're going to have a very good feel just a couple days after the election. The unknown is the litigation. And honestly, no one can give us clarity as to how that's going to look, whether it gets standing or whether it's just dismissed outright and doesn't have any impact.
Based on the lawyers that both camps are bringing into the fold and the types of arguments that they have traditionally made, what are the likely legal cases that we could see coming out of this?
Yeah, look, I think that ultimately what you've seen from the Trump campaign thus far is signaling that they're going to challenge some voter rolls. And so if it is a tight race, then that matters more, because then you can say, well, what about these 1,300 votes in DeKalb County? But if it's a wider margin, then those cases don't matter as much. Now, let's keep in mind, the Trump campaign filed a fair amount of lawsuits after 2020, and they were dismissed outright, even though that was a close election. So, look, I think that there's still some belief in institutions getting to the right answer, or federal institutions getting to the right answer here. And so I think that we will have a good feeling as to who the winner is in just a couple days after the election. I think we're going to know on election night who won the Senate, which is pretty important from a fiscal perspective. And then the litigation, I have no way of knowing yet, but I think that as long as the margin is wide enough, the market's not going to have to worry too much.
Isaac, the financial markets think that the Senate is going to go red. How big do you think the margin could be for the Republicans?
You know, look, I think if we've learned anything the past 5 cycles or so, Republican Senate candidates find a way to underperform when the market thinks that they are going to overperform. And so, look, my base case is that you have Republicans with 52 seats in the Senate. I can make a very plausible argument that you get up to 53, and there's an outside chance of 54. But I don't know if I care that much. Right. In terms of the Senate control there, you're able to apply oversight on the regulatory bodies, and you're going to be a governor on the big fiscal fights in 2025.
Isaac, is that the only high conviction view that you have going into next week? Red Senate?
That's it. That's the only one that we can moor ourselves to.
Isaac Boltansky of BTIG, seems to be a view that's shared by so many people going into next week. Their base case is that, and then everything else is just a low conviction opinion for next week.
Which is why the financial markets are thinking that a red sweep is more likely than, say, a Democratic sweep because of the Senate. Because the Democrats are just defending so many more seats, and they're already going to, off the bat, lose a Democratic seat in West Virginia. Then Montana comes into play, and then Cook Political Reports putting places like Wisconsin and Pennsylvania in play, which people, 6 months ago really thought were lean Democrat.
We've said this a million times. Things are so finely balanced in the polls. Yeah, the market's been leaning one way over the last few weeks. You just get the feeling over the last couple of days it's pulled back just a touch.
Particularly with Predicted, because the different markets are kind of diverging a bit. And there have been a couple of polls that did give Kamala Harris a lead over Donald Trump in some of the swing states. I do have to just emphasize what he just said, what Isaac Boltansky said, which is that we have 110 more hours and that people are looking for things to say. And honestly, how come the focus isn't, to your point, Anne-Marie, avoiding any kind of misspeak that could fill that echo chamber that's looking for something to chew on? And that's why I think the question about Biden is kind of a decent one.
You mean certain people in the White House shouldn't be on the campaign trail?
I'm just suggesting, and maybe, Isaac Boltansky is saying, if he's Scranton Joe and he still has that appeal, great. On the flip side, we have lots of people looking for something to talk about with nothing to talk about. So, anything will get dissected and parsed through.
What did we hear from Evan yesterday? The one thing that swing state voters agree on in their how unfavorable they view Biden. It's -45.
Brutal.
And she needs to differentiate herself from him. So why is he going out there?
We've got lots to talk about this morning. We've got a payrolls report, 1 hour and 5 minutes away. The estimate in our survey, 100K. Up next, Ellen Zentner of Morgan Stanley Wealth Management. The payrolls report, 1 hour away. The median estimate in our survey, 100K. Mike McKee with a fact for you this morning. That is the lowest since December 2020. 100,000 as your estimate going into payrolls. Equity futures right now up by 0.4% on both the S&P and the Nasdaq 100, with 1 hour away from payrolls and 2 hours away from the cash open. Here's Manus Cranny with your morning movers. Morning, Manus.
Jonathan, good morning. The bar was essentially low for Pat Gelsinger to deliver, but he did. I think both in terms of rhetoric and numbers. You've got Intel up 5 1/3% this morning. The guidance is that this quarter they're going to make 13.3 to 14.3. The most audacious turnaround plan that has been undertaken. But they threw everything at it. They kitchen sinked on goodwill and indeed on a number of items. Nearly $19 billion was written down. This really frees up Pat Gelsinger to deliver on the most audacious rebuilding plan ever. When it comes to the rumours around ARM and Qualcomm during the conversation last night, he said that is rumour churn. But for now, the market is taking the write-down as an opportunity to really move along. Let's drive along to Apple. Dan Ives says this was a prove me quarter at Apple. I put it to you, you look at the iPhone sales, maybe take a mini buy, $46.2 billion of sales. That was a beat relative to last year, but it's the guidance. It is about going into this key critical selling season. Low, mid-single guidance for this quarter. The street was looking for 7%. So that is a real sort of an offer side on it. And also on China. China didn't do spectacularly well. $15 billion. That's lighter than we were last year. And Mark Gurman says they just keep selling product into China that people don't want. Leave you with a snapshot of big oil, Jonathan. Oil is down 20% from its April period. You've got Chevron here up this morning. They're paying out, payout. They're paying out $7 billion, more than the free cash flow. So maybe a little bit of debt to fund that. The structural cost cuts are in $3 billion. And they are still promising to be one of the biggest buyback players in this market. Oil is bid this morning. That's for a slightly different set of geopolitical reasons. Jonathan,
we'll get to those reasons right now. Manus Cranny, appreciate it. Crude is higher by 1.8% on WTI. We're back through 70. Here's the why. Under surveillance this morning, Axios reporting Israeli intelligence believes Iran is preparing another attack. Strikes could happen even before US elections on Tuesday. Sources telling Axios Iran is preparing to use drones and ballistic missiles from Iraqi territory.
So what's interesting about this is the White House came out and said that they thought that this was the end of the latest tit-for-tat retaliation. This would put an end to it. Iran clearly has other ideas, and it's not just Axios. CNN is reporting as well that there could be a response before November 5th. That is going to put the White House in a very difficult and precarious position. When we spoke to Norman Rule, though, he was talking about the fact that neither camp, Harris or Trump, want to see a wider conflict. But if you're Iran, I don't think you would want Donald Trump coming back to the White House, given the fact that he was the one that was more willing to go after Iranians like Qasem Soleimani.
And it's getting reported more and more widely. And even in Iranian media, you have a general coming out and basically saying that this was too significant of attack to allow to go unrequited. And this idea that actually quite a bit was damaged. They want to downplay it, but at the same time, it has become clear that there were some real strategic sites that were affected pretty significantly. And they don't want to take that on the chin.
Pushing oil higher. We're up by 1.7% on Brent. WTI up by 1.9. Another story for you. Elon Musk holding off a challenge to his daily $1 million giveaway to voters ahead of Tuesday's election. A Pennsylvania state judge saying the case is on hold while a federal court decides whether to take the case. The Tesla CEO is accused of violating lottery and consumer protection law.
So Musk wanted to move this from state to federal. It's moving to federal potentially. TBD when we find out about this. Jonathan, you made a great point. The election is on Tuesday, so this is not going to be decided before that. The Philadelphia chief prosecutor, though, called this an illegal lottery scheme, and Musk was warned about that. Even so, the PAC says that 13 people received $1 million checks for signing that petition.
I hope they've spent it. And I'm not sure if they can claw it back. That's the one question that I have. If you've received that money, can they claw that back?
I don't think so, but don't take my word for it. Unclear, but I don't think so.
Watch this space. More on tech earnings. Big story this morning. Intel forecasting better than expected fourth quarter revenue. The report coming as the company works to preserve cash to fund a turnaround plan. In the prior quarter, Intel cut jobs, slashed its spending, and suspended investor payouts. That stock, Lisa, is up a little more than 5% in the pre-market.
They're projecting a profit of 12 cents a share compared with the 6 cents a share that Wall Street was projecting. Talk about a low bar and being able to step over it. The key question now is, what is the plan for the structure of this company and whether they're going to remain intact? And one thing that Pat Gelsinger said in an interview with Bloomberg was that actually he has no interest in selling any pieces. He wants to raise money through maybe share sales or other types of things to beef them up, but he doesn't want to break it up.
The one thing, though, if they were to go down this path, it would come after the presidential election, because they need to know the direction of travel in Washington. And Ed Ludlow last night asked the CEO about what is going on in Washington, and I thought this was interesting. He said that Intel has not yet received any of the funds that would help it construct new facilities in Arizona and Ohio, and criticized the speed to which that money is being rolled out. Remember, this is the huge CHIPS and Science Act. Is that on the chopping block? The CEO says no, because he thinks that got overwhelmingly bipartisan support. But the politics in D.C. could potentially impact how this company sees a path forward.
Chris Verrone of Strategas was on the programme an hour and 30 minutes ago, and he pointed out the divide in tech. Within the chip makers, Intel this year is down 57%. Down 57%. It's had a brutal time of it in 24.
It hasn't been able to dominate some of the sectors that are really gaining that traction, which is AI, and really AI that goes into the cloud computing. It's not just AI. It's a matter of which AI, because automotive and industrial hasn't really worked.
That stock is up 5% in the pre-market. Let's turn to the labour market. October payrolls out in just under 1 hour. Ellen Zentner of Morgan Stanley Wealth Management writing, while the Fed won't get a clean read on job counts, incoming wage data show pressures abating and support a rate cut at next week's meeting. Ellen is with us around the table. Ellen, good morning.
Morning.
Happy Payrolls Friday. Let's talk
you.
about some estimates. No point estimates from you anymore, but we can talk about the totality of the data. Just how resilient is this labour market so far in October?
I think it's still pretty resilient. I mean, of course, we don't get clean data. You know, hurricanes, strikes, seasonal adjustment issues. I think Morgan Stanley and Co. have a 75K estimate. That's really low and lower than consensus, but it's marred by so many issues. And you look at the ADP data that came out earlier this week, strong number. Now, ADP is not a forecast of what the BLS will report today. It's not meant to be, but it didn't show jobs falling apart, and it tends to not pick up weather impacts. So that would tell you that probably the labor market isn't, falling away and the Fed just can't see it because hurricane effects and other things will impact the data.
If we get a weak number today, there will be a strong argument to look through it. How would the Fed process a strong number? How much signal is from strength today?
So I think it tells you even more so that the labor market is not slowing. The thing that I think investors need to focus on, and what I think Chair Powell is going to focus on at next week's meeting, is, yes, the data shows the economy is still strong. That's great. We're cutting because we want to hang on to that economy. It's not an argument to not cut. We don't see a re-acceleration in inflation. This is not an unemployment rate that's headed back toward the lows. Either of those two would be important and probably would lead the Fed to pause, but that's not what's expected. So you want to hang on to this great economy that we have. And to do that, you baby step your way toward neutral with the interest rate. And that's why I think they continue to cut. Despite the good data leading some market participants to believe that maybe they could skip in December.
So in other words, the employment index that we got, the employment cost index that we got yesterday, might end up being more important for the thesis that the Fed is having than the jobs report that we get later today.
Yeah, the employment cost index shows that wages are right in the pocket of where they should be to be consistent with the Fed's inflation goal. And today we're going to get some wonky wage data out of the employment report. And I would just set that aside because natural disasters tend to impact hours worked the most. And when you impact hours worked, just because of the calculation, you can get a hit to hours worked and an increase in average hourly earnings. So it looks like, oh gosh, are there still some wage pressures here? Always follow the ECI. Yellen was very good about coming out always and saying the ECI is all you need to follow for wage pressures.
So that's all systems to go. You're not necessarily seeing huge inflation in other areas either. There is this one wrinkle in the whole situation that we're going to get when we hear from the Fed on Thursday, and that is what happened 2 days earlier, which we may or may not know the outcome of, and some of the policies that could come on the heels of it. You noted that tariffs pose a greater risk to inflation than anything having to do with corporate tax relief or some of the other measures. Can you talk about how significantly that could change the narrative for the Fed?
Yeah, so I think that is, when you look at the business surveys, including the Morgan Stanley's Business Conditions Index, it is tariffs that companies are much more concerned about than what happens with corporate taxes. And that's because there is real uncertainty of, one, and this has always been the case, how tariffs flow through to impact the economy and aggregate demand, and then also inflation. So tariffs should be viewed as a one-off price level shift. And so it raises the inflation numbers for 12 months until you make that annual lap around the base effect. There is, though, the prospect for knock-on impacts. I always love to go back to this example of washing machines in 2018, where Trump slapped a severe tariff on washing machines, doubling the price, more than doubling the price overnight. And some companies raised the price of dryers, clothes dryers as well, because if you're going to go and get a washing machine, you need a dryer too. But that doesn't mean people still buy a washing machine. If your washing machine hadn't broken yet, maybe you just delayed buying one because the price had jumped. So we saw a lot of demand destruction for those items during that time. So if you're a policymaker, yes, prices increase, but you really should look through that, because eventually you're going to have a drag on aggregate demand, which itself will have a gravitational pull on inflation. So in the investor community, that is sort of the biggest argument. What does this mean for the Fed? Does it mean that inflation rises so they stop cutting? Does it mean they need to hike because inflation rises? Technically, as a policymaker, you should look through that, because you especially the kinds of tariffs that Trump has proposed on the campaign trail. Let's assume that those wishes come to fruition, right? That is a big hit to aggregate demand, and that is a big drawdown on inflation. So the Fed should absolutely ignore the temporary and near-term effects.
Look through that, and they can even cut next year?
Yeah, they can continue to cut. I think that, where I would place the risk is more front-loaded cuts than a Fed stopping. And that's because, well, we don't know what's going to happen after the election. You know what the biggest surprise would be coming out of the election? That you get a clear winner and everything goes fine. That would be the biggest surprise. And I would love that outcome. I love that outcome for the economy. I love that for us.
So say there is a clear winner when the Fed meets on Thursday, and say it is Trump, but the Fed's cutting, and then all the questions are going to be about what about inflation next year? How difficult is that going to be for Jay Powell to navigate?
Well, he's going to have to put his Bose noise-canceling earbuds in, like I do on flights, and try to ignore that. He has a deep sense of civic duty, and their domestic directive is something that's in their DNA. If something impacts the economy, then they act. And look at 2016. Throughout his leadership during Trump's presidency, he did a great job of just shutting out the noise and doing the job at hand. And so you get, something that impacts the economy after the election. Whatever that is or might be, the Fed is responding to that because it might be damaging, if it's damaging to the outlook. And so that's why I say they're already in a cutting cycle. They're rolling. They operate under the law of inertia. Once you get going, you keep going. And if there is something that impacts the outlook, it is all too easy. You talked about a low bar and stepping over it. It's easy to step over that low bar and front load some cuts if the economy needs support. So I would put the risk more to that side than to a Fed stopping.
Interesting. It's going to be a very noisy news conference next week, potentially anyway. Ellen, thank you. It's good to see you, as always. Thanks for catching up with us. Ellen Zentner there of Morgan Stanley Wealth Management. Equity futures right now on the S&P up by 0.4%, with an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Flooding in eastern Spain has killed more than 150 people this week. Rescue teams are searching for dozens of others that are still missing. The storm brought a year's worth of rain in less than 24 hours. It's raised questions about whether earlier warnings could have prevented deaths. A jury has cleared Abbott and Reckitt over claims the companies hid the risks of their premature infant formulas. It was their first trial win in litigation over those products. Abbott and Reckitt are facing more than 1,000 lawsuits alleging the formulas can cause bowel disease that has been linked to deaths and brain damage. Indonesia has precipitated the sale of Pixel phones, saying that Google has failed to meet domestic content requirements. It comes after Indonesia's government blocked the sale of iPhone 16s after Apple fell short of its investment commitments. Neither Google nor Apple made it into the country's top 5 smartphone brands last year. The $1 trillion Indonesian economy is seen as a potential growth market with over 350 million active mobile phones in the country. That's your brief. John.
Danny, thank you. More from Danny in 30 minutes. Up next on the program, preparing for noise.
We're looking for a drag on payrolls from both the hurricanes and strike. We're likely looking at a drag of, over 100K on payrolls. The October jobs report and the November jobs report will carry that noise.
Up next on the program, we'll attempt to separate the signal from that noise just around the corner from New York. This is Bloomberg. Equity futures on the S&P up by 0.4% on the S&P 500. In the bond market, yields just about unchanged. Your 10-year 328.67. Under surveillance this morning, preparing for noise.
We're looking for a drag on payrolls from both the hurricanes and strike. We're likely looking at a drag of, over 100K on payrolls. The October jobs report and the November jobs report will carry that noise. So I think you'll have to rely also on other economic data. Both the economic data and the anecdotal evidence are going to be important. Now, in terms of the Fed and how they're going to be looking at that jobs report.
So here's the latest this morning. The October jobs report less than 1 hour away. Factors including hurricane disruption and striking workers pushing Bloomberg Economics to forecast a negative 10K in non-farm payrolls, the first negative print since 2020. Rob Sockin of Citi writing, we and the markets are near 100K on a month for payrolls. Anything sizably above this figure, especially if strike and weather effects are apparent in the data, would reinforce the strength in job growth that we saw in the prior report. Rob joins us now for more. Rob, good morning.
Morning.
Noise versus signal. It's been the debate all week. How much signal would you take from real strength a little bit later this morning?
Yeah, this is a really tough one. And that's why the way I've been thinking about it is if we still get a really strong report, and by that I would put something in the, given all the effects, in the 150,000 range or above, then you can say, well, that strength that we saw in the prior jobs report, that was really something genuine, because there's still a debate if that was the one-off given the softer reports we saw before that. But this is very challenging. Some people are saying, well, certain measures of the report will be cleaner than others. But my experience when you have these big distortions is they can filter through the entire report. I mean, the household survey is self-reported. Hopefully people report themselves correctly in it, but there's always the risk that they don't. So you can have a lot of noise everywhere in this report.
Digesting weakness, I think, is going to be so much harder. Everyone says now, look through it. It's noise. If we get a really weak report at 8:30, how do you identify the difference between noise and actual cyclical weakness? What will you look for?
Yeah, and that's a great point. And the Bloomberg forecast of a negative payrolls print would be really eye-catching. And I imagine in there they're embedding even bigger weather effects, because we kind of know the strike effects from the BLS strike report that came out, but it's the weather effects and the extent of them and the spillovers that could be really extensive. Even though, as I said, that you could get noise throughout the report, in theory, the unemployment rate should be a better measure this time around than payrolls, because if people are properly classifying themselves, most of them that are away from work from weather should be classified still as not unemployed, as employed but away from weather. So I'll be looking at that. But again, given the self-report nature of it, you could still get noise there too. But it's the genuine weakness, you're right, that would be really hard to parse out, because you could have very large secondary weather effects from this hurricane.
What do you make of the ADP report coming in so strong, mixed with the beige book that really indicated quite a bit of weakness, given the internals of JOLTS data that pick your own adventure? I mean, you can make an argument of whether it was good or bad, depending on your opinion. But I just feel like there's a lot of uncertainty and contradictions baked into this data. How do you understand that?
Yeah, absolutely. And, when you look at the various flavors, as you said, in the labor market data, you can kind of pick your own argument based on what you're seeing. ADP, pretty strong data. Normally, it's not a very good signal for private payrolls, may not be capturing some of these negative effects that we're talking about. So typically, I don't look at that. But when I look at the sort of confluence of data out there, on balance, this looks to me to be a labor market where a lot of things are moderated, but most of the levels are still relatively solid. And you're starting to see some signs of turnaround in the softer data. We saw that in the Conference Board's labor market differential, which tends to track the unemployment rate relatively well. So overall, it's a very uncertain picture. But on balance, I would describe this still as not a labor market that's falling off a cliff, probably one that's stabilizing.
It's a labor market that's changing, though, and I want to talk about how it's changing. In the JOLTS data, one aspect that I thought was interesting is that the one industry that accounted for the greatest number of jobs that fell off was the white-collar industry. It seems as though there have been these rotations in the employment market and the composition of which jobs are getting created. What is the nature of which jobs are leading now and which are falling off, the rotations in the jobs market.
Yeah, absolutely. And if you think about some of the strains that you've seen, as you said, on the white collar, and you've seen certain industries being hit harder in this interest rate hiking cycle than others. Financials, information, manufacturing, which tends to also pay well. So there's been a mix of industries that have felt various strains based on the uniqueness of the cycle. But my view is what was exercising those strains on the labor market are likely mostly to improve going forward. So the Fed is cutting interest rates, inflation's continuing to moderate, and you're seeing certain survey measures pick up as well. And in the background of all of this, the consumer has been remarkably strong and continues to spend. So yeah, there's been a sort of rotation, different strains in different areas. But, as the Fed cuts rates, I think that should lift a lot of these boats.
Doesn't sound like a recession, which is what your team still thinks is the base case, but you're different. You think it's a soft landing.
Yeah, in our U.S. team, they would point to, as you said, rates are still very high on a real basis, which is true. You're still seeing some of these strains in lower income households, in smaller businesses. And if you look at certain areas of the labor market, they're very concerning. The Somm rule was set off in July, which is an excellent indicator of recessionary conditions. Hiring and quit rates have fallen. But, if you look at this episode relative to history, I think there's still a lot of strong arguments for a soft landing. The Somm rule is a good example. Typically, when it's set off, you're seeing layoffs rise for several quarters, and you're seeing the consumer roll over for several quarters. And those are two very different things in this cycle. We have very low layoff activity, and the consumers continue to spend surprisingly robustly through this period. So, there's arguments on both sides, but I think to me, the data still feel in that soft landing.
We haven't triggered that vicious feedback loop. And in fact, unemployment's retreated since then as well. Your colleague Andrew just published, and I just opened the note as we were talking, there's little risk of a pickup in inflationary pressures that would prevent the Fed from continuing rate cuts to at least 4%. Do you as a team believe at Citi that ultimately run autopilot down to 4% from here? That really the data doesn't matter too much? Because Alan Zentner of Morgan Stanley was on the programme just moments ago saying that, if anything, the Fed could front load some of that cutting back to 4%.
Yeah, it's really interesting. So on the inflation front, what we're seeing is still some pretty strong disinflationary forces. So goods inflation's running negative or near zero. Food and energy inflation are running near pre-pandemic levels. If our commodities team is right and the Middle East situation doesn't spill over into physical oil supplies, oil prices continue to fall. And labor markets have loosened a lot. And wage growth, we just got a very good ECI measure that suggests that services inflation will continue to fall. So I think on the inflation front, there is some risk as the economy remains more resilient, but it's likely to continue to come down. Now, with the Fed, I think for November and December, especially November, be very hard for them to do nothing. To pause after going 50 would look a bit silly, to have a technical term. But then, and after that, I think December is very likely. But then from there, I think it's going to depend on the economy's resilience. And also, it does matter what happens in the election, but the Fed is not going to front run, I think, what happens in the election by assuming policies. They're going to see what actually happens.
A big week coming up. Rob? It's good to see you, sir. Rob Sockin of Citi, a big hour coming up next. Nadia Lovell of UBS, Mike Collins of PGIM, Mohamed, El-Erian of Queen's College, Cambridge, Jeff Rosenberg of BlackRock.
We're looking for a drag on payrolls from both the hurricanes and strike.
It's important for us to also acknowledge that labor market's going to be noisy.
It's going to be difficult to get a clean read on the signal and the noise.
The labor market, while still solid, has slowed down quite a bit.
The bottom line is the labor market's actually pretty healthy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
This is it, the most important hour of the week. 30 minutes away from payrolls. The scores going into that payrolls report look like this. Equity futures on the S&P 500 up by 0.4%, up by close to 0.5 on the Nasdaq 100. In the bond market, after a major move through October, 2s and 10s up around 50 basis points, up another 2 on a 2-year, 418.68 on a 10-year, 428.67. In our survey, the median estimate just coming down, inching lower through the week. The median estimate now, Lisa, 100K.
And most people also looking very much at the unemployment rate, which is likely to be 4.1%, in line with where it was the prior month. That might be more telling in terms of just a cleaner read across the labor market. But really, you raised the right question, John, which is essentially, what's the market's response going to be to either? And that might be the most interesting aspect of this report.
Especially after ADP, it feels like the market is thinking maybe there would be an upside surprise. Some of them, if you're contrarian, but if it's negative, can you actually read through all that negativity? Goldman Sachs says actually it's really only going to be Helene that could shave off 50,000. Milton might not actually be affecting this market right now, and everyone's pretty much just come to the conclusion that, yeah, we know Boeing has been an issue, and that's at least 40K.
And whenever we get this report, seconds after we look at the price action, we always say it's the first move. It's not always the right move, and let's see if it sticks, particularly given that we have got one major event risk on the calendar over the next week. Coming up this hour, here's the lineup for you. Nadia Lovell of UBS expecting continued US strength. We'll catch up with Michael Collins of PGIM Fixed Income on the risk to rates ahead of a crucial window for financial markets worldwide. And we'll speak to Mohamed El-Erian of Queen's College, Cambridge, reacting to what could be a very messy payrolls print. We begin the hour 30 minutes away from the very first event of a very busy stretch. US payrolls on deck, election day on Tuesday, and a Fed decision on Thursday. Nadia Lovell of UBS writing, we expect the Fed to cut by 25 basis points next week. However, sentiment is likely to remain on guard until the presidential election uncertainty fades. Nadia joins us now for more. Nadia, it's good to see you. How long before that Federal Reserve decision can actually look at a decision from the American people, the electorate? How long before we actually get one, an outcome from November 5th?
You know, we think that you probably will have a sense of who the winner is for the presidential election the day after. Now, the makeup of Congress will take a little bit longer, just because the race in various battleground states are quite tight. But we would expect by the time you get to the weekend that we will know the composition of Congress as well.
We all hope you're right. You've got three pillars to your optimistic view: strong corporate fundamentals, solid growth, and an accommodative Fed. So let's break that down between the three. First of all, corporate fundamentals, earnings. So good so far?
So good so far. I mean, it's not as great as it was in the second quarter. We had double-digit earnings growth in the second quarter. Now we're trending to mid to slightly high single-digit earnings growth. But earnings are beating expectations. It's right in line with our above consensus expectation of 5 to 7% EPS growth. And when you look at what companies have been saying, it's been incrementally positive. You know, you heard from the bank several weeks ago, as well as some of the card companies this past week, suggesting that the consumer still remains in good shape. They were seeing some improvement into October. The industrial parts of the S&P 500 is still quite mixed. So we hope to see a rebound in ISM manufacturing to help a cyclical uptick in that area. So that's where you're seeing some of the weakness right now.
You are also seeing a real sensitivity to valuation. The response in markets to earnings really hinged on how well the company had done in the stock market in the months leading up to it. How much does that raise the specter that valuation is coming more and more into play for investors that are feeling a little nervous?
Absolutely. Your expectations were high coming into earnings, particularly for tech. I mean, we had a market that has rebounded 10% off of the October low and is looking for some sort of cyclical uptick as well in terms of the earnings growth. So we do think that that remains a potential cap on the market. If we can't get that reacceleration consistently, particularly across the 493 and a consistent upward revisions trend in tech, then you could see the market not react as positively going forward.
The reason why I ask this is because when I think of valuation, I think that on a relative basis, suddenly bond yields start to matter a little bit more. And Priya Misra of JPMorgan was on earlier this morning, and she was saying she thinks that if you start to see 10-year yields breach 450, all of a sudden stock markets, risk assets are going to start to wake up a little bit more and pay attention. Is that in your risk case?
I think that's a possibility. We do think that the 10-year will come back down. But yes, near term, that is a risk. But why is the 10-year moving up, is the question. There is an argument that some of it is part of the Trump trade, but also some of it is just because we have gotten better economic growth. Economic growth continues to surprise to the upside. And so if it's because of that, the market can work through that. Yes, those areas of the market that are more interest rate sensitive, whether it be small cap, for example, could face some headwind. But we think like the other larger parts of the market, particularly tech, can work through that.
Nadia, could we go back to the election? What gives you the conviction that you think we're going to know relatively quickly?
The conviction comes from and you saw that in the last election, the betting markets, the financial markets start to make some assumption. You might not get a call on the election. We didn't get a call on the election until several days later in the last election cycle, but the market will start to suss it out, depending on how ballots are coming in some of the key swing states, whether it's Pennsylvania, which we will know probably within, that later that night, to start to put some chips on the table on where the outcome could be.
I'm just always struck because Arizona is talking about potentially 10 to 13 days. And if, say, it came down to that state, maybe this is a market that's trying to price in potentially what policy might look like out of Washington. You have two likely scenarios. What are they?
Two likely scenarios. Now, I want to preface that we think that it's too close to call. It's 50-50 coin flip. But the two likely scenarios we think is Harris with a divided government and then Trump with a Republican sweep. Now, that will yield different outcomes in markets. A Harris with a divided government, probably more status quo, a continuation of the Biden initiatives. We could see a bit of a relief rally, though, in some of the renewable names that have been under pressure. And then Trump with a sweep, again, is going to be, we think it's slightly positive, but honestly, it's a tough call because you have competing policies here. Not only the possibility of lower corporate taxes and easier regulation, but then the tariffs.
You do think it has the potential to shape sector-level performance, though? Because There are some people on this programme that come on and say it doesn't really matter. We look at previous cycles, stocks go up. Do you disagree with that?
We do disagree with that. It does matter at the sector level. Consumer discretionary. Remember, during the last, trade war, it came under pressure because if you have supply chains abroad, you're facing some incremental potential costs, and the decision has to be made. Do you absorb those costs of higher tariffs, or do you pass it on to the consumer? Last time, companies absorbed some of that. So parts of consumer discretionary, as well as even parts of tech and industrial, could be under pressure from higher tariffs.
Chris Verrone of Strategas was on the programme earlier this morning, and he talked about a pro-cyclical tilt in equities, the performance that he's seen in financials and discretionary versus staples. Would you suggest then at this point that's been more about the underlying fundamentals, the earnings we've seen, the economic data, than maybe about the politics and next week?
It's a combination. I would more lean into, particularly for financials, that it's fundamentals. I mean, we've had a pretty strong earnings season. Capital markets seem to start to recovering, and we have a curve that's starting to steepen, and a Fed that's lowering interest rates, and so that could alleviate some pressures on deposit costs going forward. So it's a combination of things, but we think at the end of the day, and we've been saying a lot to our clients, that it's more about the profits than the politics right now.
We're 20 minutes away, there and about, from this jobs report. And as you listen to the commentary from corporate executives, how much do you see a desire to hire, but kind of a waiting period to really understand what the framework is going to look like?
That's a great question, Lisa, because what we've heard in the second and third quarter earnings season is that some companies have been delaying CapEx as well as hiring intentions due to the political uncertainty. And so we'll see what the print is at 8:30. We know that it could be noisy, and I do agree that the risk is to the upside. And if we get above 200, the market might not like that because there's a repricing in the rates market.
So that's where I wanted to go. Is that a negative read-through? Have we reached the point where there is a negative read-through, where good news is bad news in risk assets because of that rate overlay?
Absolutely. We do think that there's some truth to that. I mean, right now, the market is pricing in 40 basis points of cuts for the rest of the year. We think that that's fair. We're looking for 50. So the 80% probability of a December cut is reasonable. That could get taken off of the table if we do see a very strong payrolls, and that could create some headwinds to some segments of the market.
Nadia, thank you. It's good to see you. As always, Nadia Lovell there of UBS. The first of three big events over the next week. This morning, payrolls 20 minutes away. Then next week on Tuesday, an election in America. Then 2 days later, a Federal Reserve decision. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Oil prices rising after a report that Iran is weighing a possible attack on Israel in the coming days. Axios reporting that Iran is planning a strike through militias it backs in Iraq, carried out with drones and ballistic missiles. Oil tumbled at the start of the week after Israel's limited strikes on Iran, which led to a war premium quickly unwinding, though analysts at the time warned that the market had relaxed too quickly. The latest data out of China indicates that the economy has stabilized following Beijing's stimulus push. Official and private measures of factory activity in October exceeded analyst expectations. The Taishan Manufacturing and Purchasing Managers Index unexpectedly rose to 50.3 last month from 49.3 in September. Meanwhile, home sales saw their first rise this year. General Atlantic is leading a $500 million funding round for AI-based marketing tech startup Insider. Insider plans to use the funds to expand its business in the U.S., develop its software, and explore potential acquisitions. The company was founded in Istanbul in 2012 and now has over 1,500 customers with major brands like Samsung and Walt Disney. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Up next on the programme, the Morning Calls Plus. We'll catch up with Michael Collins of PGIM Fixed Income. With the October payrolls report just around the corner, those numbers drop in about 18 minutes' time. From New York, this is Bloomberg. From New York City, welcome to the program. Big 30 minutes coming up. Equity futures going into all of that. Positive by 0.4% on the S&P 500. Bond yields higher by a basis point or two. The 10-year 429.87. Let's get you some morning calls with big tech in focus. First up, Baird raising its price target on Intel to 25, expecting faster gross margin expansion. That stock higher in the pre-market by close to 7%. Your second call from JPMorgan raising its price target on Amazon to 250, saying it's comfortable with current capex given a clear path to AI monetization. That stock is higher by 7.3%. And finally, Barclays lowering its price target on Apple to 184, citing weak revenue growth expectations. That stock moving in the other direction, negative 1.7. Turning to the bond market with payrolls just around the corner, Treasuries posting their worst monthly loss since 2022, ahead of three key events over the next week. Mike Collins of PGIM Fixed Income joins us now for more. Mike Collins, a major move in this bond market. And I went back just a few weeks to some notes that you put out before you joined us last. And it was going into the last payrolls report. And you said the biggest risk was skewed towards higher rates on an upside surprise. That was 50 basis points ago. On a 2-year and a 10-year, Mike. What's the balance of risk going into this one?
Yeah, I'll have to admit, Jonathan, I don't think I expected that big of an upside surprise. The bond market has really kind of been acting with tremendous volatility, very kind of schizophrenic-like, right? Just 6 months ago, Jonathan, you think about what was priced in terms of the long-term funds rate. It was 4.25, right? It was the long-term funds rate forever. And then it went down to 2 3/4 a month and a half ago or so. And now it's at 3 5/8. Those are giant moves on basically little wiggles in the data, right? So I think today, because of the uncertainty around the number and the hurricanes and the weather, I think you need a really big surprise on the upside, let's say above 200, or on the downside below 0, probably to move the markets. I think the markets are going to discount anything kind of in that 0 to 200 range. But, you know, I think the tendency is that the markets have sold off a lot. My bias is that we're oversold here on the rate side, that 3 5/8 permanent funds rate for the rest of our lives is probably 50, 75, 100 basis points too high.
So, Mike, you'd buy bonds going into next week?
Yeah, I think this is a buying opportunity. We've been talking about 4 to 4.5% on the 10-year, Jonathan, as being the buy zone, and we're right in the middle of that. I personally believe the 10-year is probably going to spend more time between 3.5 and 4 over the next, let's say, 5 or 10 years. So I do think there's a big kind of permanence of higher growth, higher inflation, you know, maybe more debt issuance, and a higher funds rate priced into the market, right? And that doesn't make sense to me, right? In the next 6, 12 months, yeah, that could very well be right. But over the next 5 and 10 years, and that's what long-term bond investors, that's how our clients think or should think, that 3 5/8 funds rate just seems too high. There's too much, you know, positivity priced in. The markets have priced in that no landing scenario where you've taken out any probability of a recession or downturn indefinitely.
Well, some people would argue, Michael, that there's actually a premium baked in here that really reflects the deficit and how much debt the U.S. is going to issue, especially if you do get certain tariffs that are implemented and that causes inflation to go up. There are some questions about what kind of ability the U.S. will have to finance those deficits. Do you just reject those arguments outright as sort of irrelevant and they haven't proven to be true, so they're not going to be?
No, I think it's going to be a problem, Lisa. I think it's the debt service, right? It's not the debt stock that's really the problem. It's the debt service because that gets paid every day, right? And the amount of interest expense that the U.S. government, the Treasury is spending relative to their overall budget or relative to their revenues or relative to GDP is going up and up and up. And the higher for longer that funds rate stays, the more pressure it puts on the Treasury. That means they have to allocate more of their financial resources to servicing interest, paying, foreign investors, paying wealthy investors interest, which really hurts the economy over the longer term. So what the end game is, right? And this is what we think about as long-term investors. How does this play out? And I think it's back to the Fed, right? Ultimately, that funds rate has to be lower, right? So the Fed, ostensibly will be, bailing out the Treasury, but effectively they're going to be supporting the economy by cutting rates because the sustainability of this interest expense is going to be untenable.
Given that, Mike, how much are you going into Treasuries, but also going into credit, also going into riskier securities, simply because you see any type of response to really come from the Fed as an offset to that incredible deficit, not necessarily to try to counter it or counter inflation?
Credit has done great. The fundamentals have been fine. Valuations are stretched. I think the markets, from the corporate market to the high yield market to the private markets to the real estate markets, were really grasping onto the idea that rates are going to be a lot lower. Right? A couple hundred basis points lower, let's say, in a year. And now that we've taken 100 basis points off that, I think that's going to have a financial tightening impact. It's going to have an impact on consumer fundamentals, corporate fundamentals, real estate fundamentals, et cetera. So I think there's more pain to come. Our message, Lisa, has been very clear to our clients. You add duration at these levels and you reduce credit risk, right? That's the trade we have on or putting on. And I think that is really the direction of travel. That's where the value is. It's in the Treasury market. If you look at that supply premium that you talk about, Lisa, yeah, it's gigantic. If you look at 30-year Treasury yields versus 30-year interest rate swaps, for example, that number is over 80 basis points, right? That is a gigantic credit or liquidity or supply spread that the Treasury pays every time they issue a 30-year coupon at an auction. And that used to be a negative number, right? So Treasury spreads have widened 150 basis points in the last 2 decades. No one really talks about that. And that's, something that's really kind of baked in there. So I think that's where the value is in the Treasury side, more so than the credit side.
Mike, speaking of wider spreads, Germany versus the US ended October very close to 200 basis points. Given everything you've just said, do you think that spread's too wide as well?
I don't know. I mean, we need to have a higher yield, maybe the right numbers between 100 and 200, Maybe that's a little too high, Jonathan, but they're expected to grow probably 100 basis points, if not more. Right now, they haven't grown at all. Right, Germany has had zero GDP growth really since pre-COVID. It's been one of the worst performing countries in Europe, and we've averaged 2.5, right? So I mean, or even higher right now. So that's that argues for a 200 basis point premium, and so maybe that's not unrealistic.
We're at 190 right now. Mike is going to catch up. It's good to see you. Michael Collins at PGIM Fixed Income. Going into payrolls in about 9 minutes' time. We caught up with BlackRock earlier this week, who talked about the divergence they're expecting on both the growth side and the deficits between Europe and the United States.
Which is the reason why, and Priya was talking about this, she really likes the European debt market simply because you do see that kind of deceleration. But here's the issue. Over the past couple of weeks, the past week in particular, we saw German yields skyrocket. We saw yields in Australia skyrocket, even though they have some negative numbers. So what gives? Is this a matter of them actually having any autonomy over their market, or are they basically completely pegged to what happens in the U.S. and the Treasury market?
So gilt yields do that in the last few days as well, but that's a very UK story that we can avoid because we've got payrolls in about 8 minutes' time. The median estimate is 100K. With us around a table, Mike McKee. Mike, we've been talking about the noise that we can expect from this number all week. How much noise will there be?
That's an interesting question because when you look at the hurricanes, they took place on either side of the survey week. Helene was in September, there were probably still a lot of people out of work, but it's not the immediate reaction. And Milton was halfway through the survey period, almost to the end of the survey period. So maybe if people were on payrolls for an hour that week, then they're already being counted as employed. So it may not be as bad as people think, but we just don't know.
Do you think there's a very real risk of a much stronger number here this morning?
I think there's a risk of a stronger number than the market is betting on at this point. I think people are really kind of hedging. When you look at what the whisper number is 136. Wall Street's definitely leaning towards more strength. If we get the kind of number that Steve Rasciuto is talking about, 180, then you're going to have everybody going back to this U.S. economy is really strong question. And the Boeing thing is important because if the union does accept the contract, goes back to work, then Boeing starts turning out airplanes again, and the economy gets stronger in the fourth quarter than people thought.
Where is the strength coming from? Where does a number like 216 on jobless claims yesterday come from? What's the source of that?
All of us. We're spending money, consumers are spending, and so companies are still hiring at this point. And, the sectors change. I'm sure there's a lot of people we'll see in the jobs report who are doing hurricane relief, construction, things like that. But at this point, it's just an overall good economy. We're kind of running in a virtuous circle.
Given the fact that this is going to be a messy number, and given the fact that it is a messy moment for the Fed next week on Thursday, how much are they going to be looking more at the ECI figure from yesterday, at some of the other inflation metrics that are coming in as justification to keep their cutting cycle?
Oh, they'll be looking at it as permission to keep their cutting cycle. The cutting cycle will be dependent on whether or not the economy is strong enough that they think it will produce inflation. And with the strong numbers we've had, ECI is still showing that there isn't an inflation problem. So they'll feel they can keep going.
How about revisions? How closely are you watching revisions as sort of the tell this time?
Well, we've been watching revisions a lot because they have come in, and last month is strong. And last month they were very strong, the number of revisions. So we'll watch that today. But I think the real key is that people are going to be looking at what the October numbers were, because we're trying to figure out what's going on ahead in this case to figure out where we go from here.
Mike, stay close. The big one drops in 5 minutes' time. Coming up, we'll catch up with Mohamed, El-Erian of Queen's College, Cambridge. We'll speak to Jeff Rosenberg of BlackRock, here to react to the jobs number. In our survey here at Bloomberg, the median estimate is 100K. The range is wide. At the high end, it's Mizuho at 180. At the low end, it's Bloomberg Economics, led by Anna Wong, looking for negative 10K. Based on the disruptions, this should be a weak print. Based on the data so far for October, this should be a very strong print. And that's why this could be anything. It feels totally random this morning. The random number generator drops in about 4 minutes' time. Equities going into that up by 0.4% on the S&P 500. Bond yields creeping just a little bit higher after advancing more than 50 basis points across the curve through October. The 10-year up 2 basis points. We reclaim 430. The 2-year up 2. We're through 420. The number drops up next. The October payrolls report seconds away. The scores going into it look like this. Equity futures on the S&P 500 firmer by 0.4%. On the Nasdaq 100, up by 0.4. On the Russell, up by 0.2. In the bond market, 2-year, 10-year, 30-year. Your 2-year yield, 420, up 3 basis points. Your 10-year up 2 to 431. Your estimate is 100K in our survey here at Bloomberg. With the numbers, here's Michael McKee. Good morning, Mike.
Good morning. Well, the random number generator comes very close to Bloomberg Economics. 12,000 jobs created. Last month revised down to 223 from 245. The unemployment rate, no change, 4.1%. The change in manufacturing payrolls, and I assume this has a lot to do with the low overall total, negative 46. Change in private payrolls, negative 28,000. So it does look like we have had some hurricane impact here. And I'm just looking at what the BLS is saying about that. They were during the reference periods. So the survey collection rate, they say, is well below average. And at this point, it doesn't say... I don't see a number in terms of what they think, but they do say that this has all been affected by the hurricanes. So it could be revised significantly next month when more data come in. Rest of the numbers, average hourly earnings up 0.4. That's a surprise. The expectation was for a 0.3 gain. On a year-over-year basis, we're at 4%. Average weekly hours, 34.3, which is also a bit of a surprise. If you're not going to be working because of the hurricane, average hourly hours go up. Labor force participation rate, 62.6. That's down a tick from last month, and that probably has something to do with the hurricanes. And I would say also average hourly earnings higher, probably because a lot of the people who were out of work were lower paid employees in the service industries.
So, Mike, we've got a lot to work through. So let's start with the headline number. The estimate at the high was 180, at the low was -10. The number is 12K. So that's a big downside surprise. Let's look first at the bond market and see how yields are reacting to this on a 2-year, 10-year and a 30-year. On a 2-year, we were at 420 going into the number. We're down about 5 at the moment on the session now at 412. On a 10-year, we pulled back by 2 basis points after breaching 430 briefly, just going into the print, 426.66. In the equity market on the S&P 500, just a sneak peek at equities, still near session highs, up by 0.5%. And off the back of this, as you might expect, with lower yields, you push that through foreign exchange. A stronger euro, a weaker dollar, euro-dollar, just pushing 109. Mike, when you look through this, I want to compare and contrast two very different things. Headline payrolls and unemployment. Unemployment at 4.1%, steady. Headline payrolls, dramatic downside surprise. Two different surveys. Tell me about the survey that produces the unemployment rate and the kind of question that would be asked that would generate a steady, stable 4.1%, and maybe that's the cleaner read this morning.
Oh, basically, it's, are you employed? And whereas you have to spend an hour at work for the establishment survey, if you have a job, if you tell the BLS that you have a job, then you're counted as employed. Now, employment in the household survey went down by 368,000. Unemployment only went up by 150,000, but there was a 220,000 drop in the number of people who were in the labor force. So a lot of people probably, it's a certain extent, could be people who saw their business wash away. They don't know if they have jobs. So at this point, when you put it all together, you get the 4.1%, but it's two different ways of looking at it.
Because the challenge for us all this morning is to draw a distinction between cyclical weakness and one-off short-term noise. How easy or difficult is that to do this morning?
Well, I think it's reasonably easy to look at this and say there's a huge hurricane effect, but we don't know exactly what it is, as the BLS says, because the response rate was very low to this survey. Companies did not respond because maybe they were a little bit busy during the time cleaning up. But when you look at manufacturing jobs were down 46,000, construction jobs only up 8,000, and there's usually a rebound in construction jobs after natural disaster as people rebuild, and that probably has not been captured yet in the numbers. Retail trade down 6,000, trade and transport down 1,000, professional and business services down 47,000. That's an area, and temporary help down 49. That's an area you want to check into because we don't know yet whether that's because the economy's slowing, which is usually a sign when you see those numbers go down, or because they were caught up in the hurricane as well. 40,000 jobs in government, which is largely state and local, probably a seasonal effect from education because there are only 1,000 jobs added at the federal government. And then leisure and hospitality down 4,000. That's going to be a hurricane-related thing as well.
To me, two numbers stand out. 4.1% for the unemployment rate and the revision down to 223. Basically, to me, it seems like this could be a report that many people in the market and certainly the Fed could come out and say, this basically is really messy and we're going to have to parse through all the mess, but it's pretty much in line. Is that kind of the way that you would view this?
Yeah, I think this doesn't change the Fed's mind about what it's going to do at all. When you see the 4.1% unemployment rate and the 0.4 gain in wages, the wage number may be distorted by the hurricane, but it's still in line with what we have been seeing. So it's not a major boost to inflation danger. And then you mentioned the ECI before the numbers came out. Inflation seems to be under control on the wage side. So they'll look at the jobs number and say, we're going to have to wait till next month till we get the revisions and see once companies start reporting how many people are on payrolls. We'll find out, which is interesting because you look at the ADP number, which came in at 233, was very strong for private sector jobs compared to a negative number for non-farm employment on the private side of negative 28,000. ADP is looking at what's in their computers to pay people, whereas the establishment survey, people have to send in the information.
I called it the random number generator going into it. I don't think that gives Anna Wong over at Bloomberg Economics enough credit, who was looking for negative 10K. The number this morning, 12K. The range of estimates was really wide. At the high end, 180 over at Mizuho. The median estimate in our survey was 100K. In response to this data, your market looks like this. So let's start with the bond market. Fixed income, 2-year, 10-year and a 30-year. And as you might expect, off the back of a downside surprise like the one we just got, yields are much lower by 8 basis points on a 2-year. Only 6 minutes ago, 6-7 minutes ago, the 2-year was at 420 and the 10-year was at 430. We're now down 4 basis points on a session at a 10-year to 424.45. Looking at equities, equity futures still elevated. Still up by 0.5% on the S&P. On the Nasdaq, up by 0.6. To kick off the conversation, Jeff Rosenberg joins us now over at BlackRock. Jeff, how useless is this number this morning?
Well, it's a good question, Jonathan. A lot of noise in this number between the revisions, between the strike impact, between the hurricane, the BLS not coming out with much clarity on that. So I think the market reaction is to the headline disappointment. We were underpricing to 100% probability on November. I think that makes sense. I think the discussion on the wages and focusing on ECI is probably the bigger story, focusing on the unemployment rate, a more important read-through for the Fed. And I don't think this is going to really significantly change the near-term trajectory. I think more importantly is the longer-term trajectory has been repriced dramatically. And I don't think anything we see in today's data is going to reprice that into 2025 pace of Fed expectations, given the noise in today's data.
Let's bring Mohamed into the conversation as well. Mohamed El-Erian of Queen's College, Cambridge joins us now. Mohamed, we'd love your early reaction to this. And just tell us, is this noise, is this weakness we can look through?
So my 3 takeaways, and the first one speaks to, is it noise, is it signal? 3 elements on noise, we should look through them: payrolls, labor force participation and earnings. The 4th one, unemployment, I agree with Jeff, that has more information content. 2 is, if you want to make more of this data, then go beyond the big 4 headline numbers and go into the details. And you need to do that if you're going to derive any economic and policy implications from this report. And then finally, the reaction of the bond market has to do with 2 things. One, as Mike noted, the whisper number was even higher than the consensus 100,000. And as you noted earlier, the balance of risk was on the upside for the market. So what you're seeing is a repositioning that people were hedging a little bit, because the one thing that would have really moved things is a much stronger number, not a much weaker number. And that's something that you noted earlier today, John.
Mohamed, I'm struck by the fact that we've gotten so many revisions and so many unclear numbers that we can't fully rely on. How much are you really taking more signals still from what corporate executives say and from the Beige Book and some of that commentary than some of the numbers that we've been getting out that show and really have led this expectation in markets that there should have been an upside surprise?
So, Lisa, this is a time when you've got to take a very holistic view and also have a pinch of salt added to all that, because we have some major events coming up. Look, on the whole, I think the data are consistent with an economy that's still robust, an inflation rate that is proving somewhat more sticky than you would like, and a major call for the Fed to exit this notion of fine-tuning and go into a world where it has a steady steer on interest rates. It should be cutting by 25 basis points for the next few meetings, and then revisiting after that. It should not be looking to react like it had in July by not cutting, like it did last time by cutting 50 to every basis point. It should just be steady, because this data is going to be noisy, and that's what happens at inflection points.
Jeff, to that point, and a number of different people who've come on the show today and in the past few weeks have pointed to this idea that maybe the Fed could front load rate cuts because they are on sort of this steady steer right now, that they do have room to make rates less restrictive in tandem with inflation coming down. Based on these numbers, is that basically your base case, too, that they're going to take this window to front load?
Yeah, if you look at where the market has been moving, it's not really been in the November and December expectations. The Fed's kind of done a pretty good job saying we're going to front load. There's a debate about whether 50 was a mistake or not. Okay, let's put that to the side. That's behind us. So it's really about the forward-looking 2025, 2026 path. That's been repriced. And I think the story going into next year will be the Fed talking about, hey, we've gotten started here in terms of normalization. We don't have to go quite as fast because away from today's data, the economic data, yesterday's data, is much stronger than the kind of fears over a very restrictive Fed policy would otherwise say. So they can kind of pull back. Maybe they start to talk about every other meeting. That's kind of in the price. And so I think the Fed's got itself in a better place. We're going to get the front-loaded cuts, 50 last time, 25, 25, and then every other meeting that's kind of aligned. And then we'll see where the data goes and where the debate on R* and how restrictive are we really. The economic data has held up pretty well. Yes, this is a downside disappointment, but the broader message is labor markets have been normalizing. They're not collapsing. They're normalizing. They're still trying to stick the soft landing, and I think the soft landing is still the message.
If you are just joining us, welcome to the program. Just moments ago, 12 minutes ago, we got a big downside surprise on a payrolls report. Came in at 12K. The median estimate was 100. I want to remind you of some words from a speech from Governor Waller in the middle of October ahead of this number. Governor Waller said this at the Federal Reserve. This report will most likely show a significant but temporary loss of jobs from 2 recent hurricanes and a strike at Boeing. I expect these factors may reduce employment growth by more than 100,000 this month. He went on to say, since the jobs report will come during the usual blackout period for policymakers commenting on the economy, you won't have any of us trying to put this low reading into perspective, though I hope others will. So let's do that right now. Mike McKee, you got some more?
Yeah, looking again at the hurricane impact, according to the BLS, the establishment survey was affected for 2 reasons, they say. One is that the hurricanes probably prevented people from answering. And also the survey period, the way they phrase it is it ended several days before the end of the month because of the timing of the month. And so they may not have gotten all the surveys in that even were answered. So we're going to have to look at next month to do it. The survey, as Lisa points out, is the lowest survey response rate, lowest since 1991. And when you look at what the weather is overall, it's understandable. Now, the other part of it is the household survey, and the BLS specifically says that was not affected by the storms. So the number you can trust is the 4.1, Jeff Rosenberg was pointing out, and the number you got to hold in abeyance is the 12,000.
In some ways, do you think this makes the Fed's life just a little bit easier next week? Wouldn't a stronger number have been the bigger problem in the news conference?
Oh, a very strong number would have been something that they would have to have talked around. Now they can say, well, we seem to be on the same path, and unemployment's not going up, and average hourly earnings on a year-over-year basis haven't changed, so we don't have a problem. We can cut.
Unemployment's not going up. Bond yields aren't either. This morning, they're down by 9 basis points on a 2-year. On a 10-year, we're down 5. Just moments ago, 15 minutes ago, we saw 430 on 10s. On 2s, we saw 420. Mohamed, I want to bring you into the conversation on fixed income because you wrote earlier this week in Bloomberg Opinion the importance of understanding what's behind this move. And we've heard a bunch of people give a bunch of reasons as to what's behind it. It might be the data, it might be deficit concerns, it might be policy concerns going into next week. Have you decided on which one it is at the moment, Mohamed? What do you think the dominant factor is going into next week?
I have not, John. I don't think you can, because there are at least 4 influences, and it's very difficult to determine the weight of each. Over the next few days, we're going to have some major developments. We're going to have the Fed recalibrating again. We're going to have the results, or at least we'll know how the vote went for the elections. So we're going to get some important data point. I'm really glad you read out Chris Waller's speech, because he has emerged as the best Fed policymaker in terms of not only assessing what has happened, but telling us what to look at. And I thought what you read out was really interesting. Of course, we may always get a newspaper leak during the blackout period. But I think the Fed right now is looking at this, and I agree with what was said, is that they'll say, you know what, this is not going to influence what we're going to do, and we're going to cut by 25 basis points next week.
Of course, yields are lower, so they might not need a particular person to leak anything out to the market to correct the impression. Jeff, what do you think in terms of the main drivers of the yield rise that we've seen over the past month, the 50 basis points increase across the curve?
Yeah, I'll agree with Mohamed. I mean, there's a lot of cross currents in there, but I would say a big one not to ignore, and it's hard because we're obviously, very focused on the prospects of post-election fiscal policy, is that the economic data got much better, and you had a very negative, very extreme level of Fed expectations priced into the bond market. So it's a little bit of combination of the bond market kind of getting over its skis in terms of 50s and consecutive 50s, and the accelerating the expectations into pricing on the weakness. And then when you started to pull some of that weakness back in terms of the economic data that started to come in, then you had a reaction to that. So I think, that's kind of probably the main thrust. There's a lot of other stuff, as Mohamed's talking about, in there. And Jonathan, yeah, absolutely. I think this makes their life easier. It would have been harder if this was a big upside surprise. Certainly the number is overstated in terms of its weakness because of strikes and hurricanes, and I think everyone knows that. It makes it easier for them to deliver on the 25 cut, which they certainly want to do. And I think that's an important point to highlight.
There's also revisions to the downside for the prior month. So, Jeff, is there a possibility that 50's back on the table?
I would say for November, that's still a pretty high bar. The revisions are part of the noise, and I think the signal is the household survey, the 4.1%, the ECI number, the GDP numbers, although they have their own revision problems. But overall, you have a K-shaped recovery, but in aggregate, despite the distributional differences, the aggregate is doing very well. And I think that's driven by the ease in financial conditions, the support for consumption, what we saw in terms of the revisions in GDI and savings rate. The consumption side is still in aggregate very well supported here. And so that, more than the noise out of the payroll reports and the difficulty in measuring that on a month-to-month basis, is going to drive the outlook for Fed policy going forward.
Well, Mohamed, when the Fed meets next week, Jonathan is right. This may actually help them and make their job easier. What might make their job very difficult is the presidential election. And already we are seeing this number be politicized. The Trump camp is coming out calling it, quote, brutal. What does the Harris camp need to come out and explain about this jobs report to an electorate that says the economy is their number one concern?
And Marie, they need to explain that the numbers have been heavily influenced by one-off effects, painful one-off effects, especially with respect to the hurricanes, but they're one-off effects for now, and also by the strikes. And they need to do that because they have not taken sufficient control of the narrative. We talk day after day of economic exceptionalism. That's not what the narrative is out there, as you know. The narrative is out there is about the cost of living, about inflation. And people don't realize that this economy has been outperforming not just expectations, but has been outperforming the rest of the world. And this is really important. As to the Fed, look, it boils down to two numbers. One mentioned by Jeff, ECI, the 0.8% increase, the quarterly increase in employment cost. You look at that and you're relaxed. The other number is the PCE inflation, the monthly 0.3% increase. You look at that, you're not so relaxed. And they're going to have to balance that. And I think if you balance that, you end up with a 25 basis point cut. You certainly do not go to 50.
Mohamed, November just feels like an easy decision for them. If they don't have a result to the election, if you get the jitters in markets, it's another reason to cut by 25 basis points. December is where things get a little bit harder. A question we've gone back to on the programme a few times. We've had this discussion with you too, and I'd love your thoughts going into the weekend. Whether you really believe next week's election has the real potential to redefine the economic backdrop, not just in America, but worldwide. And whether by the time we get to December, the Federal Reserve will really have to think about the policy initiatives on the table, even if they are not yet reality in Washington, D.C.?
John, I've been bemused by how confident some people have been in predicting what will happen here, what will happen there. Look, you're trying to solve, think of it as a 4 by 3 plus 2 matrix. So think about it. There are 4 potential outcomes in Congress. There are 2 potential outcomes for who wins the presidential election, and a third one, which is no one for a while. And then, even when you solve for Congress and you solve for the president, you've got to solve for a third issue, which is how much of what is being said will actually be implemented. I remember what happened in 2016. I remember how the market turned on a dime when the winning candidate at that time came out with a completely different narrative than what was said during the election campaign. So the Fed on Wednesday morning is not going to be able to solve for this 4 by 3 by 2 matrix. So I think what they're going to do is say, we put this aside, we will react based on what we know, and then we will revisit this issue.
Jeff, that's what it feels like. Just to build up what Mohamed was saying, it feels like we're on autopilot to the high estimate of neutral, which could be around 4. So you get a few more cuts, you get closer to 4, and the decision gets harder. Because I think for many people, we are truly flying blind into 25 and perhaps even beyond, based on the outcome of next week. And Jeff, I'd love your view on that and whether you agree with that view.
Well, I think the key observation is we've gotten a little bit closer in terms of a more reasonable expectation of the level of Fed cuts relative to the debate or the distribution around where is neutral. Whereas a month ago, you were very much weighted to one side of that debate, which is we're very far away from neutral. We got to cut quite a bit. And what is the data that sort of pushes against that excessive amount of cut, the very low level of neutral? Economic growth, right? We know it. You don't know where neutral is, so you know it where you see it. And where you see it is in the data. And so the piece that has kind of been missing here for a while is where is the slowdown? Yes, the payroll. Yes, the labor markets are slowing, but they're not tightening, and they're certainly not eroding to the level of degree that would scream, oh, we need to cut 50 basis points at each meeting because this economy is hard landing. So it's really come back. It really comes back to this kind of basic fundamental, which is you see it in the economic growth data. There's lots of inputs to that. We can look at earnings. We can look at payrolls. We can look at layoffs. You can look at the leading indicators for the job market, and not much in there screams that this is excessively tight. The only thing that screams that you're excessively tight is a historical comparison of the real rate relative to past real rates. Outside of that, the economic data says financial conditions are how monetary policy transmits. It's much easier than the rate or the real rate would imply, and so you don't need to cut as aggressive. And that's kind of recognized in the bond market, so there's less disagreement, so therefore less potential volatility from realizing that disagreement.
Mohamed, just before you go, a final word, please, going into next week. How would you navigate next week?
John, I would wait. And mentally, I would change the paradigm. For a very long time, we looked at the stage, the economic and policy stage, and we looked at the Fed as the principal actor. Going forward, we should think of the Fed as stepping back, and there'll be 3 other principal actors. One is fiscal policy, the second is tariffs, and the third is the combination of reforms, deregulation, and industrial policy. So mentally, John, we're going to have to evolve. And it's really hard because we have been conditioned to look at the Fed as the only game in town. But we're coming into a world, as Jeff said, where the Fed is going to be going backward, going to the side, and allowing 3 other actors to determine where this economy is going. And we just need to change our mindset to make sure we allow for them to enter our mind and assess them better. And it's going to be hard, John.
I'm going to be kind to you both, because that's hard enough. I'm not going to ask for election guesses. Mohamed, you can go. Appreciate your time, sir. Mohamed El-Erian of Queen's College, Cambridge, alongside Jeff Rosenberg of BlackRock. If you are just joining us, you missed the fireworks. 12K. Big downside surprise on a jobs report. We were looking for 100, a huge hurricane disruption in this number. Some weakness, some noise that a lot of you assume we can look through. And the Federal Reserve themselves can look through as well and cut 25 basis points next week. Between now and then, we've got a big election coming up. So as we count you down to the opening bell, here's the trading diary through next week. On Monday, a sprinkle of economic data, durable goods. Tuesday, the US presidential election. On Wednesday, PMI data. Thursday, a decision from the Federal Reserve, another round of jobless claims, plus a rate decision from the BOE. And on Friday, I've got no idea if you'll still be awake by the time we get to Friday morning. Mitch, consumer sentiment. Mike McKee, thank you, sir. As always, as we look ahead to next week, coming up on Monday, Stephanie Roth of Wolf Research, Dan Niles of Niles Investment Management, Mike Wilson of Morgan Stanley, and the Ryanair CEO, Michael O'Leary. Have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.